Please like, share, and subscribe. Wishing you happiness and good luck every day.
What if I told you that almost everything you think you know about investing is, well, wrong? Today, we're diving into the Bogleheads Guide to Investing, and we're going to uncover a brilliantly simple philosophy that pretty much flips conventional wisdom on its head. And it all kicks off with a really interesting puzzle. I mean, just think about it for a second. In your job or with your house, if something serious goes wrong, what do? You hire the best expert you can find, right? You work on the assumption that you get what you pay for. But here's the crazy part. In the world of investing, if you apply those same, perfectly logical rules, you're, and this is a quote, destined to leave you poor. So why? Why is that? That's the big mystery we're going to solve today.
And that question brings us right to the heart of the Boglehead philosophy, what I'm calling investing's contrarian wisdom. It's the simple but honestly profound idea that the financial markets play by a completely different set of rules than almost any other part of your life. And getting your head around this, well, that's the absolute key to building real wealth.
Now, this is where it gets really interesting. This is the core insight from the founder of Vanguard, Jack Bogle. See, before you account for any costs, investing is what's called a zero-sum game. For every single person who beats the market, there has to be someone else who underperforms it. The math just doesn't work any other way. But then, you have to subtract all the real-world costs, the management fees, the trading commissions, taxes, and once you factor those in, the average investor's return actually drops below the market average. And just like that, a zero-sum game becomes what Bogle famously called a loser's game.
So, who are the folks who actually figured this all out? Well, let's meet the Bogleheads. And no, they're not a bunch of Wall Street wizards in expensive suits. They are something much more powerful and, honestly, a lot more relatable.
The entire philosophy that we're talking about today, it's all laid out right here in this book, The Bogleheads Guide to Investing. And you'll notice, it's not some secret manual from a big Wall Street firm. Nope, it's a collection of wisdom from a whole community of regular people who just figured out a better way to do things.
At their heart, the Bogleheads are a community. That's what it's all about. They're just individual investors who get together to help each other stick to a shared philosophy, all inspired by Jack Bogle. And that philosophy really boils down to three things: embracing simplicity, obsessing over low costs, and having a laser focus on the long term.
And this quote from Bogle himself just nails the whole idea. The majesty of simplicity, that's about saying no to all the complex, super expensive products that Wall Street loves to push. And an empire of parsimony? That's just a really poetic way of saying be cheap. Because in investing, every single dollar you refuse to pay in fees is another dollar that stays right there in your pocket, compounding for you.
Okay, so we've got the foundation. Now let's get to the fun part, seeing how the Boglehead philosophy is built. And it starts by tearing down all the myths that Wall Street wants you to believe. This is really where the whole approach just shines, by showing you all the traps you need to avoid.
Oh, this slide is just fantastic because it puts it all right there side by side. On the left, you've got that common sense that feels so right, but it's a total trap. Hire an expert usually just means hiring someone who's going to charge you high fees that eat away at your returns. You get what you pay for is actually flipped on its head here. Low-cost funds consistently do better than their expensive counterparts. And chasing last year's hot stock? That's a proven recipe for buying high and selling low. And panicking in a crisis? That's the quickest way to turn a temporary drop into a permanent loss. The Boglehead principles on the right are the complete opposite. And that's exactly why they work.
The book makes a great point that the financial industry basically thrives on all this complexity and noise, the exact stuff that leads us into those common sense traps. And they do it by repeating what the book calls the three biggest lies. First, that promise that we'll beat the market, which, as we now know, is a loser's game for almost everyone. Second, that seductive little whisper that this time it's different, which is what tempts you to ditch your entire strategy. And finally, that vague appeal to just trust us without being totally upfront about what it's going to cost you.
And let's be absolutely clear here. This isn't just some philosophical debate. Following these myths, falling for that failed common sense, it has a real tangible cost. As the book warns, it's a path that is, quite literally, destined to leave you poorer.
Okay, so we've busted all the myths. If that's the wrong way to go, what's the right way? Well, this is what the Bogleheads call the simple path. And it's got nothing to do with being some kind of financial genius. It's all about being disciplined.
And here it is, the entire strategy boiled down into 5 powerful steps. Number 1, start as early as you possibly can and invest on a regular basis, no matter what the market is doing. 2, keep it simple. We're talking just a handful of broad, low-cost index funds. 3, keep your costs microscopic because costs are one of the only things you can actually control. 4, diversify a lot so you own a tiny piece of thousands of companies all over the world. And number 5, this is the hardest one, but it's the most important. Stay the course. Just tune out all the noise and let your plan do its job. This right here, this is the fundamental shift in your thinking. You stop playing that stressful, unwinnable game of trying to outsmart everybody else. Instead, you choose to play the very winnable game of just capturing your fair share of whatever the entire stock market returns, and doing it efficiently with the lowest possible cost. You're not trying to find the needle in the haystack anymore, you're just buying the whole haystack. So to wrap things up, I want to leave you with this quote from Benjamin Franklin that's highlighted in the book. This just proves that the Boglehead philosophy isn't some new fad. It's timeless, fundamental wisdom. It's all about focusing on the very few things you can actually control: how much you save, the costs you pay, and your own behavior. Because those little expenses, those small leaks, the little fees, and the panic decisions, those are the things that sink even the greatest financial ships over time. So the question to ask yourself is, what small leak in your own strategy could you go plug today?
So, what kind of financial life do you actually want? It's a really simple question, right? But the answer? Well, it pretty much determines everything. And here's the thing, it's a choice we're all making, whether we realize it or not. In this explainer, we're going to make that choice crystal clear.
Let's kick things off with a number that should, honestly, be a little terrifying. Okay, picture this. You take 100 young Americans, right at the start of their careers. How many of them do you think will be financially independent by the time they hit 65? The answer is just 5. Yeah, only 5. That means a staggering 95% of them fail. They just won't have enough to stop working and keep living their life. That's the reality for almost everybody. So what that really means is that every single one of us right now is on one of two paths. You're either on the path of the 95% or you're on the path of the 5%. Every single dollar you spend, every decision you make is pushing you down one of those two roads. But here's the crucial part. You can choose to switch paths. And that choice, it starts today. Okay, so how do you figure out which path you're actually on? Well, it all comes down to 3 basic financial lifestyles. And as I describe them, I want you to be brutally honest with yourself. Which one sounds like you right now? Are you a borrower, a consumer, or a keeper? You know, what's fascinating is that each of these lifestyles really just boils down to a single core idea. Borrowers, they live only for today. Consumers are kind of stuck on that hamster wheel, just thinking about the next paycheck. But the keepers, they're playing a different game. They're focused on growing their total net worth. It's a complete shift in how you see money. All right, first up, let's talk about the most dangerous group, the borrowers. Their entire life philosophy is basically, forget tomorrow, let's live for today. Their financial life is a house of cards, or maybe more accurately, a house of credit cards. The idea of paying for something with money they actually have is like a totally foreign concept. There's this fantastic Texan saying that just perfectly describes the borrowers. Big hat, no cattle. They look the part, you know? They've got the brand new car, the huge house, all the latest gadgets. But just below the surface, it's all propped up by this mountain of crippling debt. One unexpected medical bill, one layoff, and that whole thing comes tumbling down. Now, most people aren't full-blown borrowers, but they fall right into the next trap, being a consumer. For consumers, every single major purchase, we're talking cars, TVs, you name it, gets filtered through one simple and very dangerous question. Can we afford the monthly payments? And if the answer is yes, they buy it. End of story. This obsession with monthly payments keeps them trapped on a treadmill. They will always choose the new TV or the trip to Disney World over building any kind of real, lasting wealth. And the craziest part? They will literally turn down free money, like an employer's 401k match, just because it might slightly reduce their immediate take-home pay. They think they own their lifestyle, but they don't. They're just renting it, one paycheck at a time. And that brings us to the goal. This is who we want to be, a keeper. They just completely flip the script. They get it. They understand that earning money just to spend it all is a losing game. The real game, the one that matters, is about one thing and one thing only, systematically growing their net worth over time. So how do they do it? What's the secret? Well, it's a few simple but really powerful rules. First, they always pay themselves first, saving at least 10% of every single paycheck before anything else gets a dime. Sure, they use credit cards, but only for convenience, and they pay that balance in full every single month. And they're smart about big purchases. They buy cars that are a few years old and let some other person take that massive hit from depreciation. Look, this isn't about being cheap, it's about being strategic. They absolutely still enjoy life, but every choice they make is part of a bigger plan to build wealth.
All right, so you're ready. You want to be a keeper. That's awesome. But here's where most people get it wrong. They try to jump straight to investing. Before you even think about stocks or crypto or anything else, there are 3 non-negotiable steps you have to take first. This is the foundation. Everything else gets built on top of this.
Step 1 is all about a crucial mental shift. You have to graduate from obsessing over your paycheck to obsessing over your net worth. This right here is the single most important number in your entire financial life. It's the real score. It's simply everything you own minus everything you owe. Remember, it's not about what you make, it's about what you keep. Calculating this is actually pretty easy. You just make 2 columns. On the asset side, that's the stuff you own. You list things like the cash in your bank accounts, the value of your home, any investment you have. Then you make a list of your liabilities. That's what you owe. So your mortgage, any credit card debt, student loans, car loans, all of it. You just subtract your total liabilities from your total assets. And that number you're left with, that's your net worth. Your whole goal is to make that number go up.
So how do you stack up? This table here shows the median net worth for American families broken down by age. Go ahead, take a second and find your age group. Are you above or below the median? Now, this isn't about judging yourself. It's just about getting a clear, honest look at your starting point. You can't chart a course to where you're going until you know exactly where you are right now.
Okay, once you know your starting point, it's time for step 2. And this is where we go on the attack. Your mission, should you choose to accept it, is to destroy any high-interest debt you have, especially from credit cards. And I'm not being dramatic when I say this. This is a financial emergency.
Why an emergency? Because of numbers just like this one. Let's say you've got an $8,000 credit card balance. If you only make the minimum payments, you will end up paying over $7,000 in interest alone. Just let that sink in for a minute. You'll spend a total of $15,000 just to pay for $8,000 worth of stuff you probably bought years ago. It's a machine designed to destroy your wealth, and it's working against you 24/7.
So let's reframe this completely. Paying off a credit card that has an 18% interest rate is an investment. It's a guaranteed, risk-free, tax-free 18% return on your money. I promise you, you will not find a better or safer investment anywhere on planet Earth. This has to be your absolute #1 priority. Okay, with your high-interest debt destroyed, you have now cleared the way for the 3rd and final foundational step, building your cushion. This is your emergency fund. It's the financial shield that protects your entire plan from all of life's inevitable curveballs. So how much do you actually need? This chart gives you a super simple guideline. If you have a really stable job, you can probably aim for 3 months' worth of living expenses. For most people, though, 6 months is the sweet spot. And if you're self-employed, or maybe you're in a less stable industry, you'll want to have a full year of expenses saved up. And where does this money live? Just remember 2 words: safe and liquid. This is not money you invest, it's not money you take risks with. It has to be there, immediately accessible the second a crisis hits. A high-yield savings account or maybe a money market fund, those are the perfect spots. So let's put it all together. This is it. This is your path to freedom. Step 1, know your net worth. Step 2, destroy high-interest debt. Step 3, build your emergency fund. That's the plan. If you can master these 3 steps, you're not just on a new path. You've built an unshakable foundation for a lifetime of financial success. We've laid out the map. You can see the dead-end roads of the borrowers and the consumers, and you can see the clear, proven path of the keepers. So the question is no longer, what should I do? The only question left is, when will you take that first step?
You ever wonder if becoming a millionaire is just for people with those 6-figure salaries or, lottery winners? Well, today, we're going to tear that idea apart. In this explainer, we're going to uncover the simple, kind of boring secrets that can help you build some serious wealth, no matter what you earn.
Okay, so let's just dive right in with a story that sounds completely impossible. But I promise you, this is 100% true.
So this is from a real letter sent to the investment company Vanguard.
And it tells the story of a totally regular person, someone who never, not once, made more than 25 grand in a single year. And yet, over their lifetime, they somehow built a portfolio worth $1.25 million. So you have to ask, right? How on earth is that possible? I mean, this wasn't some stock market genius or a lottery winner or somebody who got a huge inheritance. This was just an everyday person. So, what was their secret?
Well, the first part of the answer is a force so powerful that Albert Einstein supposedly called it the eighth wonder of the world, and that is the magic of compounding. There's this super handy little tool called the Rule of 72. All you do is divide the number 72 by your annual rate of return and boom! That tells you roughly how many years it's going to take for your money to double. So let's say you get an 8% return. Your investment doubles every 9 years. It's so simple, but it's incredibly powerful. To really get a feel for the power of this, let's play a little game. Imagine you start with just 1 penny. That's it. But this penny has this wild ability to double in value every single day for a month.
Okay, so after 10 days, you've got $5.12. Yeah, not exactly life-changing, right? You're probably not too impressed yet. And honestly, this is the slow, boring part where most people just lose patience and give up.
But let's skip ahead another 10 days to day 20. That single penny, it has now grown to over $5,000. Whoa! Okay, now we're talking. The momentum is building. That little snowball is getting bigger, and it's rolling way, way faster. And now for the big finale. You ready for this? By day 30, that one little penny is now worth over $5.3 million. That explosive, almost vertical growth you see at the very end, that, my friends, is the insane power of compounding. So compounding needs one crucial ingredient to work all that magic. And that secret ingredient is time. Which brings us to the single biggest, most costly mistake that people make. We're talking about the high cost of waiting. Let me show you what I mean with a quick story about 2 investors. We'll call them Eric Early and Larry Lately. So Eric starts investing at age 25. He puts in $4,000 a year for just 10 years. And then he stops completely. Larry, on the other hand, waits until he's 35 to start, but he's diligent. He invests that same $4 grand a year for a full 30 years, all the way to retirement. So let's look at the actual cash they put in. Larry invested $120,000 of his own money. That is 3 times more than Eric's $40,000. I mean, common sense would tell you Larry is going to end up with way more cash at the end, right?
But this is the part that blows my mind. At age 65, Eric, the guy who stopped investing 30 years earlier, ends up with 29% more money than Larry. He has almost $630,000. And why? Just because his smaller amount of money had an extra decade to just sit there and compound. It turns out time was way more powerful than the total amount of money he invested. Okay, so we've established we need compounding, and we absolutely need time. But what's the fuel for this whole engine? This is where we get to the real secret, the one part of this entire equation that is 100% in your control. And it all comes down to this simple truth. You can't invest money you don't save. It's just not possible. That decision, figuring out how much of your paycheck to actually put aside, that is the foundation for everything else. It's the starting line. And look, this isn't just my opinion. A major study by the National Bureau of Economic Research tried to figure out what really determined how much wealth people had when they retired. And you know what they found? It wasn't about being smarter or luckier or getting a big inheritance. Nope. The single biggest factor was that some people simply make the choice to save more of their income than other people do. It's a habit, it's a choice, that's it. All right, so if saving is the absolute key, the next question is pretty obvious. Where does the money come from? Especially if you feel like you're already stretched thin. So let's get practical here. Let's look at a few simple but really powerful choices. First up, a classic. Pay yourself first. Just automate it. Have at least 10% of your paycheck go straight to savings the second you get paid, before you even have a chance to spend it. Then there's the small daily stuff. Making your own lunch and coffee, instead of buying them, can easily free up like $10 a day. And here's the painless one. Whenever you get a pay raise, commit that new money directly to your investments. You won't even miss it. But you know, of all the spending habits out there, there is one that has the potential to absolutely drain your future net worth more than pretty much anything else. And that is how we buy our cars. Just think about this number for a second.
By simply choosing to drive a reliable 3-year-old used car instead of a brand new one, the average person saves about $2,500 every single year. That's in depreciation, insurance, payments, the whole shebang.
But here's the real payoff. If you take that $2,500 you save every year and you invest it, assuming an 8% return, that one simple choice could become over $1.1 million by the time you retire. Let that sink in. One decision can make you a millionaire. I think this quote from a 23-year-old investor just brings it all home perfectly. When you're just starting out, your saving rate, how much you put away, is infinitely more important than stressing about finding the absolute perfect investment. Just building the habit, that's the real victory.
So as we've seen, building wealth, it's not really about being some financial wizard. It's about making simple choices, being consistent, and letting time do the heavy lifting. So the real question isn't, can you do it? It's this: what one thing will you do differently tomorrow to start building your future? Stocks and bonds. You hear those words thrown around all the time. But what are you actually buying when you invest in them? You know, it's probably the most fundamental question in all of investing. And getting it right, that's the real first step to building wealth. So today, let's cut through all the jargon and figure out what it truly means to be an investor.
Leave it to Warren Buffett to make something so complex sound so simple. And this quote, it's perfect. Before we even get into definitions, he's asking us to completely shift our mindset. See, this isn't about nervously watching prices flash on a screen. It's about having the confidence to own something for the long haul, even if you couldn't sell it tomorrow. That's the foundation we're building on today.
All right, so here's our game plan. First up, we're going to tackle the one core idea that splits stocks and bonds right down the middle, the difference between owning something and loaning something out. Then we'll dive deep into the world of stocks and what it really means to be an owner. After that, we'll flip the script and look at being a lender in the world of bonds. And, super important, we'll see why you actually need both. We'll wrap it all up with a simple framework to start building your own blueprint.
You know, when you strip away all the complicated charts and the fancy Wall Street talk, investing really boils down to just two fundamental choices. You can be an owner, buying a piece of a business, or you can be a lender, loaning your money out. That's it. Seriously. Every complex investment product you ever hear about is just some variation of one of those two things. So let's put these two paths right next to each other. When you buy a stock, you are buying ownership. You become a part owner of that company, and that means you get a share in its potential profits and its growth. Now, buying a bond, that's totally different. You're basically acting like the bank. You are the lender, and the bond itself is just a formal IOU from the company to you, promising to pay you back with interest. Owner versus lender. It really is that simple.
Okay, so let's walk down that first path, the path of ownership. What does it actually feel like to own a tiny little piece of a massive global company? Well, welcome to the world of stocks.
It is so easy to think of a stock as just, a ticker symbol blinking on a screen. But it's so much more than that. The moment you buy even one share of a company, you are legally an owner. You own a tiny fraction of everything that company has. Its factories, its patents, its brand name. You are quite literally a part of the business.
So, how does this ownership actually put money in your pocket? Well, it happens in two main ways. The first is what we call price appreciation. It's simple. If the company does well, more people want to own it, and that drives the price of your share up. You can then sell it for more than you paid for it. The second way is through dividends. This is when the company takes a chunk of its profits and pays them directly to you, its owner. Pretty cool, right? But here's the catch, and it's a big one. A stock's value isn't set in stone. It can bounce all over the place, sometimes wildly, based on what millions of other investors think it's worth at any given second. It's this constant tug-of-war between buyers and sellers. And that dynamic right there is what creates both the potential for huge gains and the very real risk of being an owner. Okay, let's switch gears completely. If stocks are all about the potential ups and downs of ownership, bonds are about the stability and the predictability you get from being a lender. Let's explore the other side of the investing coin. A bond is, at its heart, just a loan. The easiest way to think about it is like an IOU. You give an organization, say a big company or the government, a specific amount of money. In return, they promise to do two things. First, they'll make regular interest payments to you for a set amount of time, and second, they'll give you your original loan amount back, that's called the principal, on a specific date in the future known as the maturity date.
And who are these borrowers? Well, it's all sorts of different groups. The U.S. Treasury issues bonds to fund the government, and these are widely considered the safest loans on the entire planet. Why? Because they're backed by the full faith and credit of the U.S. government. Corporations also issue bonds to raise money for big projects, like building a new factory. And even your local city or state issues bonds. We call them municipal bonds to build things we all use, like schools, bridges, and roads.
Okay, so on one side, we've got the growth potential of ownership with stocks. On the other, we have the steady income from lending with bonds. Now, you might be tempted to just pick one and go with it, but the real magic in building a strong portfolio isn't about choosing one over the other. It's about understanding how they work together to create balance.
And here is the key concept you need to know: low correlation. Now that's just a fancy way of saying that stocks and bonds often act differently from each other. Think of it like a seesaw. When the stock market is flying high, the bond market might just be chugging along steadily. But when the stock market takes a nosedive, bonds often hold their ground, or sometimes even go up in value.
Let's put this idea to the ultimate test. Think back to the financial crisis in 2008. The stock market was in an absolute freefall. People watched their life savings get slashed by 30, 40, even 50%. It was terrifying. But in that exact same year, a simple, kind of boring bond fund didn't just survive, it actually gained over 5%. Now that is not just a number on a screen. That's peace of mind when the world feels like it's falling apart. That is the power of balance.
This is exactly why so many experts call bonds the shock absorber for your portfolio. Think of your stocks as your offense, out there trying to score big points, where your bonds are your defense. They provide stability and can help prevent a catastrophic loss when your offense is having a really bad day. They're the buffer that lets you sleep at night.
So, we get the pieces now, and we see why they fit together. But let's get to the most important question. How do you actually use all this to build a portfolio that's right for you? Let's talk about creating your own personal blueprint.
Need a place to start? Here's a really simple rule of thumb from the legendary investor Jack Bogle. Take your age and use that as the percentage of your portfolio that you hold in bonds. So if you're 30, you might start with 30% in bonds and 70% in stocks. As you get older and closer to needing that money, your mix automatically gets more conservative. Now, it's not a hard and fast rule, but it is a fantastic logical starting point.
So how do you actually buy them? Well, you've got two main routes you can go. You can buy individual bonds, one at a time. The big plus here is there are no ongoing fees, and you know exactly when you'll get your principal back. The downside? It can be expensive and kind of complicated to buy enough of them to be properly diversified. The other option is a bond fund. Think of it like a big basket that holds hundreds or even thousands of different bonds. You get instant diversification, which is amazing for safety. The trade-off is you'll pay a small annual fee to the people managing the fund. There's no single right answer here. It's just about what works best for you. So there you have it. You now understand the two fundamental building blocks of investing: the growth engine of stocks and the stable foundation of bonds. They are the simple, powerful tools you need to start building your financial future. So the only question left is, what are you going to build?
Have you ever looked at your investment options and just felt your head start to spin? Yeah, you're not alone. You hear all these terms thrown around: mutual funds, annuities, ETFs. It's like an alphabet soup of financial products. So, what's the real difference? And which one is actually right for you? Well, today we're going to cut through all that noise and demystify your portfolio using the clear, no-nonsense wisdom from the Bogleheads Guide to Investing.
You know, to get us in the right mindset, let's start with this classic quote from the legendary investor Peter Lynch. It's such a great reminder that successful investing isn't about some magical ability to time the market perfectly. It's about making smart, informed choices for the long haul. And that all starts with understanding exactly what it is you're buying.
So, feeling a little overwhelmed by all these options? Good, you're in exactly the right place. Over the next few minutes, we are going to break these terms down piece by piece so you can see exactly how they work and, more importantly, where they might or might not fit into your financial plan. All right, let's kick things off with the absolute workhorse of the investing world, the mutual fund. According to the Bogleheads Guide, for most of us, this is the place to start. So let's dig in and see why.
At its core, a mutual fund is a really beautiful and simple idea. It's basically teamwork for your money. It pools cash from thousands of people just like you and me. A professional manager then takes that giant pool of money and invests it in dozens, sometimes hundreds of different stocks or bonds. And you get to own a tiny slice of that entire portfolio. And the variety here is just huge. You've got funds that focus only on stocks. We call those equity funds. Then there are bond funds for more stable income, and balanced funds that give you a nice mix of both. You even have money market funds, which are designed to be a super safe place to park your cash. Seriously, there's a fund for pretty much any investment goal you can think of.
Now, these funds are run in two totally different ways. On one side, you have active management. This is where a fund manager tries to be a hero, right? They're picking individual stocks, trying to outsmart everyone and beat the market. Then, on the other side, you have indexing. An index fund doesn't try to be a hero, it simply tries to be the market. It just buys all the stocks in a benchmark like the S&P 500 to match its performance. And here's the kicker. It's incredibly hard for those active managers to consistently beat the market, especially after you factor in their much higher fees. Indexing just harnesses the market's power at a very, very low cost.
So, why are mutual funds so popular? Well, it boils down to a few huge advantages. With just one purchase, you get instant diversification, which is really just a fancy way of saying you're not putting all your eggs in one basket. They're run by professionals, you can often get started with very little money, and they're super easy to buy, sell, and even set up on autopilot. It's a really powerful combination.
Okay, let's totally switch gears. We're moving from the world of pure investing into something different. It's a hybrid product that the Bogleheads Guide calls an investment with an insurance wrapper. Let's talk about annuities.
So why would someone even look at an annuity in the first place? Well, it usually comes down to the appeal of a guarantee, the promise of a secure income for the rest of your life. That can sound pretty compelling, right? Especially if you're worried about outliving your savings. And that's the problem insurance companies say they can solve with annuities. But as we're about to see, those guarantees often come at a very, very steep price.
The definition itself is the key here. This is a product sold by insurance companies. That's maybe the most important thing to remember, because it means you're not just investing, you're signing a complex legal contract. And like with any contract, all the important details and the potential traps are buried in the fine print.
And that fine print often involves staggering costs. Just look at this number. The source material points out that thousands of these investment options inside variable annuities charge over 2.5% per year. To put that in perspective, a cheap index fund might charge you less than 0.2%. A fee this high is, to use the book's own words, simply outrageous.
And it's not just the annual fees. There are other traps. Many annuities have these things called surrender periods, which can lock up your money for 10 years or even more. If you want your cash back before then, you're going to pay a huge penalty. They might also lure you in with the high teaser interest rate that vanishes after year one, leaving you stuck in a lousy product. The guide calls these gotcha clauses, for a very good reason.
Here is a fantastic analogy right from the source. One of the big selling points for an annuity is that your money grows tax-deferred. But what happens if you put that annuity inside a 401k or an IRA, an account that's already tax-deferred? Well, you don't get any extra tax benefit. It's pointless. You're just paying for a second raincoat when the first one was already keeping you perfectly dry.
This line from the book, it just says it all, doesn't it? It suggests that most people who own annuities didn't actively seek them out after careful research. No, they ended up with one because a salesperson, who is probably earning a very high commission, convinced them to buy it. It's a huge warning to always, always be a skeptical and educated buyer. Now for our third and final category, exchange-traded funds, or ETFs for short. You can think of these as the modern, slick cousin to the traditional mutual fund. So an ETF is kind of a hybrid. Like an index mutual fund, it holds a whole basket of stocks that tracks a benchmark. But here's the big twist. Instead of buying it from the fund company at the end of the day, you buy and sell it on a stock exchange all day long, just like you would a share of Apple or Amazon.
So here are the key differences side by side. A mutual fund gets its price calculated only once per day, after the market closes. An ETF's price, though, is changing constantly, second by second, while the market is open. This also means you usually have to pay a brokerage commission every single time you buy or sell an ETF, which isn't always true for a mutual fund.
But there are some potential downsides to be aware of. If you're investing small amounts of money regularly, those little commissions can really add up and eat into your returns. And sometimes, an ETF's price on the market can drift a little bit away from the actual value of all the stocks it holds. But maybe the biggest danger is also its greatest feature. The ability to trade all day can really tempt you to try and time the market instead of just sticking to your long-term plan.
Okay, so we've unpacked mutual funds, we've waded through the murky waters of annuities, and we've checked out the modern structure of ETFs. Now, let's bring it all home. What's the bottom line? What should you really take away from all this?
This right here is your cheat sheet. Let's walk through it. For most people, mutual funds really hit that sweet spot. They're generally low cost, they're simple, they're liquid, they make an ideal core for almost any portfolio. On the complete opposite end of the spectrum, you've got variable annuities. Very high cost, terrible liquidity because of those surrender fees, and super complex. The source suggests you should only ever consider them in very specific niche situations and only after you've maxed out every other possible option. And finally, ETFs. Very low cost and highly liquid, but their trading complexity makes them best suited for investors making bigger, less frequent investments. So, what is the final verdict from our guide? After weighing all the evidence, the conclusion is incredibly clear and powerful. For the vast majority of people, simple, low-cost mutual funds are the winning ticket. They're the right tool for the job. So the question to leave you with is, does your portfolio reflect that wisdom? Thanks for tuning in.
Let's talk about how to protect your savings from something that's quietly eating away at it every single day: inflation. It's a huge challenge for any long-term investor, right? But the good news is there are some pretty specific tools designed to fight back, and we're going to break them down. I love this quote: "A silent thief in the night." It just perfectly captures the problem, doesn't it? See, you can catch a burglar, but inflation? It's sneaky. It doesn't steal your TV, it just quietly steals the value of your money. Your future buying power just evaporating. And hey, this isn't some abstract economic theory. It is very, very real. Imagine this. You stash $1,000 under your mattress. 10 years later, you pull it out. You've still got $1,000, right? Well, yes and no. You have the same number of dollars, but you've actually lost ground. That money just doesn't buy what it used to. And if you want to see just how powerful this is, get this: $1,000 back in 1935. To have that same buying power in 2005, you would have needed over $14,000. Whoa. That is 70 years of inflation just silently working against you. It's like compound interest, but in reverse, and it is not your friend. Okay, so let's dive in and really get to know this silent thief. We need to understand what we're actually up against when we try to protect our hard-earned cash. Now, this chart is really, really interesting. It's looking at super safe government T-bills. That top line, that's what your statement says you earned. Looks pretty good, doesn't it? Almost always going up. But look at that bottom line. That's the real story. That's your return after inflation gets its grubby hands on it. See all those spots where it dips below zero? That means even in one of the safest investments on the planet, people were actually losing buying power. And get this, that's before taxes even enter the picture. So that really begs the question, right? If even super safe government bonds aren't a sure thing against inflation, where do you turn? What's the answer if you just want to guarantee you don't lose money? Well, here's the good news. The US Treasury actually came up with a solution. In fact, they came up with two powerful tools specifically for this problem: I-bonds and something called TIPS, which stands for Treasury Inflation Protected Securities. So let's break them down. All right, first up, I-bonds. Let's take a look at how these things are built to go toe-to-toe with inflation. So the I in I-bond, yep, you guessed it, stands for inflation. Their whole job, their entire reason to exist, is to shield your money from losing its value. And because they're backed by the US government, they're about as safe as an investment can possibly get. And the way they work is actually pretty clever and simple. It's a two-part recipe. Part one, a fixed rate. Think of this as your guaranteed profit on top of inflation, and it's locked in for the whole life of the bond. Part two, the inflation rate itself. This part gets adjusted twice a year to match whatever inflation is doing. You just add those two rates together, and boom, that's your total return. It's a pretty straightforward way to make sure your money holds its own, well, at least before taxes. Ah, but you knew there had to be a catch, right? And it's the same catch there always is: taxes. Let's talk about how Uncle Sam plays a role here. So you've got this bond that's designed to beat inflation. But what happens when the tax man comes for his cut? Well, the IRS taxes everything, both that fixed rate part and the inflation adjustment part. And this table really shows you what that means in practice. Okay, follow me here. Say you're in the lowest tax bracket, that 10% one. After 30 years, your $1,000 is worth about $1,230 in today's money. Not bad, you came out ahead. But now, look over at the person in the 35% bracket. After taxes, their $1,000 is now worth $974. They actually lost buying power. Wow. The taxes didn't just eat the profit, they took a bite out of the inflation protection itself. So that's the key takeaway here. I-bonds are great, but they are not a magic bullet against taxes. The higher inflation goes, and the higher your tax bracket, the bigger the bite taxes will take. Now, there is a silver lining. The tax is deferred. You don't pay a dime until you cash the bond in, which for a lot of people might be in retirement when hopefully they're in a lower tax bracket. Okay, so this whole tax thing brings us to our second option from the Treasury. TIPS. That's Treasury Inflation Protected Securities. And they tackle this problem from a totally different angle. But before we dive into TIPS, we have to get our heads around this kind of weird concept called phantom income. It sounds spooky, but here's all it is. With TIPS, as inflation goes up, the value of your bond goes up, but you don't actually get that extra money in cash until the bond matures or you sell it. Here's the crazy part. The IRS makes you pay taxes on that increase in value every single year, even though the money isn't in your bank account yet. It's income that's a ghost. You're taxed on it, but you can't touch it. So you can see TIPS are a totally different animal. Their rate isn't set by the Treasury, it's set by the market at auctions. You can also buy and sell them whenever you want, unlike I-bonds, so more flexibility. But that tax treatment, that's the biggie. Because of that phantom income thing, a lot of advisors say, hey, maybe you should hold these inside a tax-deferred account, like an IRA. That way you don't have to deal with that weird tax bill every year. Okay, so now that we know the players, let's put them in the ring. I-bonds versus TIPS. Which one is better? Well, it really boils down to that classic trade-off, simplicity versus flexibility. This chart kind of says it all. You've got I-bonds on one side. There are these simple set it and forget it option. You buy it, you hold it, you deal with taxes way down the road. Then you've got TIPS. They're the more, let's say, hands-on option. You get rates set by the market, you can sell them anytime, but you have to wrestle with that tricky phantom income tax thing every year. So what about the bottom line? How do the numbers actually shake out? Let's look at this comparison. We've got an I-bond with a 1% real return and a TIPS with a 1.5% return. And look at that. Even with the annual taxes, that slightly higher rate on the TIPS gives it a little bit of an edge. In every tax bracket, the TIPS investor ends up with a little more cash after 10 years. But, I mean, we're not talking about a huge difference here. And that's why the source material basically concludes with this. For all practical purposes, it's a toss-up. After running all the numbers, the difference is often so small, it's pretty much a rounding error. I mean, after a whole decade, you might be looking at a difference of less than $50. So what's the big takeaway from all this? Well, there's no single right answer for everybody. The Treasury has given us two really solid, safe ways to fight back against that silent thief, inflation. Do you go with the simple, tax-deferred I-bond or the more flexible, market-driven TIPS? The choice really comes down to you, your tax situation, your goals. But the most important thing is that now you know the tools, you know the pros and cons, and you're in a much better position to protect your own buying power. So, how much do you really need to save for retirement? Let's be honest, for most of us, this is one of the biggest, most anxiety-inducing financial questions we'll ever have to deal with. It feels so massive, right? It's the kind of thing you just want to push to the back of your mind and hope it all works out. But today, we're going to tear it all down and make sense of it. All right, let's kick things off with a little humor from financial planner Jonathan Pond. I mean, saving 250% of your income, yeah, that's not going to happen. But this quote is brilliant because it just perfectly captures how absurd and overwhelming this whole thing can feel, especially if you wait too long. You know that feeling, right? That little voice in the back of your head wondering, am I saving enough? It's this worry that comes from just not knowing. So our mission here is to take that fuzzy, anxious feeling and turn it into a real number, a starting line. And you really do need to get a handle on it, because once you have a number, even a ballpark number, you can build a real plan. So enough about why this is so nerve-wracking. Let's dig into the what. What actually goes into figuring this thing out? Okay, so here's the secret. This huge, scary question, it's not actually one big monster. It's really just a bunch of smaller, totally manageable pieces. The source material breaks it down into 9 key variables. Think of them as the building blocks for your personal retirement number. So here they are. You've got stuff you can kind of control, like how much you're stashing away, when you want to retire, and how long you think you'll live. And then you have the really tricky ones, the ones that are more like educated guesses. What your investments will return, what inflation will look like, and if you'll have other cash coming in from things like Social Security. And this is such a key point. Like, you know your age, that's a gimme. But what about the rate of return on your investments for the next, say, 30 years? Yeah, that's where it gets murky. So let's zoom in on that one, because it's a biggie. Okay, let's talk about future returns. This is, hands down, the most intimidating part of the whole puzzle. And if you get this number way off, well, your whole plan can fall apart. It's that classic garbage in, garbage out problem.
So, what do? Throw a dart at a board? Nope. You can toss out the crystal ball. A way better approach is to use what the experts are forecasting for the long haul. The source we're looking at shares a forecast from Richard Furry that's built on real economic factors, not just wishful thinking.
What's so cool about this is that these are basically the ingredients for our recipe. You can see the estimated returns for all these different types of investments, big US stocks, corporate bonds, you name it. Your personal portfolio's expected return is just going to be a mix of these, depending on what you own. All right, let's walk through a quick example so you can see exactly how this works. Say 30% of your portfolio is in big US stocks. You just take that 30%, multiply it by that 7% expected return, and boom, you get 2.1%. You just do that same simple math for every single piece of your portfolio, and then you just add it all up. And voila, for this particular mix of investments, you land at 6.39%. See that? We took a giant, scary guess and turned it into a pretty solid estimate. And that number, that's a super important piece of our puzzle. Okay, so now we get how the pieces work, especially that big one, expected returns. Now let's talk about the tools that actually put all of this together for you and spit out a real number. I bet you've seen one of these before, right? It's just a basic online retirement calculator. But look closely at what it's asking for. Number of years until retirement, annual yield, annual inflation. Sound familiar? These are the exact same variables we've been breaking down. Basically, these calculators are the engine that does all the math for you. You feed in all your numbers, all those variables we talked about, and they do the heavy lifting to give you what the source material calls a ballpark number. And that's exactly what it is. It's not set in stone, but man, is it a powerful place to start. So what does this actually look like with real numbers? Let's check out a couple of examples for people at different stages. This is where you'll really see just how powerful time is in this equation. First up, let's imagine someone who's getting pretty close, just 5 years away from retiring. This table shows how big their nest egg needs to be for every $1,000 of income they want each year in retirement. So if they're hoping for a 7% return, they need to have saved just over $21,000 for every $1,000 of income. Okay, now let's jump way ahead and look at someone who's got 30 years to go. The table looks the same, but whoa, look at those numbers. They're way bigger. Why? Well, a huge part of that is inflation. That $1,000 of income is going to need to be a much bigger number 30 years from now just to buy the same stuff. So let's put these side by side, because this is the big aha moment. The person with 30 years needs a much bigger final number, over $44,000 for that same grand of income, mostly because of inflation. But, and this is the magic part, they have an extra 25 years for their money to grow and compound. That makes hitting that much bigger number so much more achievable. So, what's the bottom line here? First, remember that whatever number you come up with, it's a starting point. It's not a finish line. It's a living, breathing plan that you got to check in on as your life changes. But honestly, the most important thing, the absolute number one takeaway, is just to start. Seriously, just begin. We've gone through all the pieces, the tools, and the whole process to turn that nagging feeling into a real number. You've got the roadmap now. You know how to find your starting point. So really, there's only one question left to ask yourself. What's your number?
What if I told you that the very rules you live by, working hard, trusting your gut, always trying to be the best, are the exact things that are absolutely wrecking your investment portfolio? It sounds completely backwards, I know. But today, we're going to break down a simple, almost lazy strategy that, believe it or not, consistently wins the investing game.
Okay, so first things first, we have to tackle this huge central conflict. You know all those rules of life we're taught to follow? Well, when it comes to investing, they're not just a little off, they're actively working against you.
So let's just dive right in, Could the very principles that make you successful everywhere else in life, at your job, in your relationships, be the exact things holding you back from building real wealth? In the world of investing, the answer is a big, resounding yes.
I mean, think about the advice you've heard your entire life, right? Don't settle for average. Go for number one. Trust your instincts. When there's a crisis, you got to do something. These sound like solid, dependable principles. They're practically baked into our DNA.
But here's the twist, and it is a big one. Applying these same rules to your investments is a surefire way to end up with less money. You have to understand, investing is a totally different game with a completely different, counterintuitive rulebook. And playing by the wrong one will cost you big time.
And look, this isn't just some theory I'm throwing at you. Let's look at the cold, hard data. There's this thing called the performance gap, and it shows you the real-world cost of following your gut instead of a plan. So a huge study by a company called Dalbar tracked returns for 20 years. Over that time, the stock market itself, the S&P 500, returned about 8.2% a year. Pretty good, right? But the average person investing in the market, they only got 4.25%. That's nearly half of the return just gone. Poof, vanished.
So what on earth explains that massive gap? Well, it's all those common sense actions we talked about. It's people trying to be clever, trying to outsmart the market. They sell when they panic, they jump in and out, they chase after whichever fund was hot last year. All that action leads to one thing: worse results.
Let's make this real. Imagine you invested $10,000. If you had just earned the market's return, it would have grown to over $46,000 in those 20 years. But at the average investor's return, it's less than $23,000. That difference, over 23 grand, is the price you pay for bad behavior. It's the cost of trying too hard. Okay, so if trying to be the best, trying to be an expert, actually leads to failure, what's the alternative? Well, it's a strategy that's shockingly simple. It takes almost no effort. What if the real secret to winning was to just be lazy? And this is where our hero enters the story: passive index investing. The goal here is so simple, it's revolutionary. Don't try to beat the market, just be the market. You buy a single fund that just copies a big index like the S&P 500, and then, and this is the important part, you do absolutely nothing. You just let it ride. So why does doing nothing work so well? It's not magic. The superpower is one simple, kind of boring thing: brutally low costs. See, with no high-priced fund manager to pay and no army of analysts, the fees are incredibly small. And every single dollar you don't pay in fees is a dollar that stays in your account, working and compounding for you year after year.
And here's where it all clicks. A typical active fund might charge you 1.5% in fees. An index fund might charge, say, 0.5%. You think, it's just 1%. What's the big deal? Well, look at the numbers. Over 20 years, on a $10,000 investment, that tiny 1% difference adds up to over $11,000 more in your pocket. That's the power of compounding costs, either working against you or for you.
All right, I get it. A simple, lazy strategy that beats almost all the pros? It sounds way too good to be true. So don't just take my word for it. Let's hear from some of the smartest, most successful minds in the entire world of finance. Let's start with the legend himself, Warren Buffett. This is arguably the greatest investor who ever lived. And what does he say? He's crystal clear. For pretty much everyone, a low-cost index fund is the absolute best choice. He knows that trying to beat the market while paying high fees is, for most people, a total loser's game. I love this next quote from Jonathan Clements, a longtime Wall Street Journal columnist. He calls index funds the investor's best friend and Wall Street's worst nightmare. And why? Because they put you on the winning team, not the team that profits from making things complicated and charging you a ton of fees. Still worried about just being average? This quote from William Bernstein is for you. He flips that whole idea on its head. He says indexing doesn't doom you to mediocrity. It basically guarantees you superior performance. And how can that be? Simple. Because in a game where most players lose to the average, just matching the average makes you a winner. So, we have to completely change how we think about success here. In school, you want an A, right? But in investing, chasing that A by trying to time the market and pick stocks, well, that often gets you a D or an F after you factor in fees and mistakes. The real secret is to happily accept a guaranteed B, the market's return. In this world, a B is for brilliant. So this brings us to the final crucial question you have to ask yourself. Take a really honest look at your own investments.
Are you paying someone a premium for the privilege of underperforming? Are you putting in more effort, paying higher fees, only to get less money in return? It's time to ask if you're really playing to win, or if you're just playing by the wrong set of rules.
All right, let's just cut right to it. If you're an investor, or heck, even if you just think about investing, you're constantly buried in noise, right? Hot stock tips, crazy market predictions, super complex strategies. It's a lot. But what if I told you that your success, your long-term success, really just boils down to one single decision? That's it. Forget all that other stuff. Today, we're going to find out what that single most important decision is. And we're going to start with some wisdom from an absolute legend, the founder of Vanguard, Jack Bogle. He laid it all out right here. See, the game isn't about trying to pick the next big thing, the next Amazon or Tesla. The most fundamental question you got to answer is about your mix of assets, stocks, bonds, cash. That's the whole shebang. That's the foundation of everything. So just how important is that mix? Well, it all comes down to this number, 93.6%. Take a good look at it. Seriously, this one figure should change the way you think about investing forever. So what on earth does it represent? So where does that number come from? Well, it's from a huge landmark study on big pension funds. And what it means is this: 93.6% of what makes a portfolio's returns go up and down, it's explained by one thing and one thing only: your asset allocation. That's it. It's not about being some genius stock picker. It's not about trying to perfectly time the market. Nope. It's about the simple, deliberate choice of how you split your money up. You know, this whole idea that asset allocation is king, it kind of flies in the face of what Wall Street is always screaming about. So to really get why it's true, we need to take a quick look at some really powerful theories that completely turned our understanding of markets upside down. And at the very heart of this is something called the efficient market theory. The core idea is actually pretty simple. By the time you hear a piece of news, say a great earnings report or a cool new product, it's already priced into the stock. The market is just so competitive, with millions of smart people analyzing every bit of info, that prices adjust almost instantly. This makes finding a so-called undervalued stock, well, almost impossible. And listen, this isn't some brand new idea. It's built on more than 100 years of research. It actually started way back in 1900 in a PhD thesis. Then, in the 30s, a guy named Alfred Cowles looked at thousands of expert forecasts and basically found they were useless. The idea got more serious in the 60s with Eugene Fama, and then it really hit the mainstream in the 70s with a book that's now a total classic. Yeah, that book was called A Random Walk Down Wall Street. And that phrase, random walk, it just perfectly illustrates the whole concept. It means you can't predict the next step based on the last one. The analogy they use is just brilliant. It's like the path of a drunk person staggering down the road. You know they're moving, but you have absolutely no idea if the next step is left, right, forward, or backward. The theory is that in the short term, stock prices move a lot like that. Okay, so if we accept that trying to outsmart the market is probably a losing game for most of us, then what do? Well, you stop playing that game, and you start playing a much smarter one. And that brings us to something called modern portfolio theory, a totally different way to think about building a portfolio based on the dance between risk and reward. This was pioneered by a Nobel Prize winner, Harry Markowitz, and it completely changed the goalposts. See, the goal isn't just to chase the highest possible returns anymore. The real goal is to get the best possible return for whatever level of risk you're comfortable taking on. It's a huge shift from playing pure offense to a smart, balanced strategy of both offense and defense. Now, to get this, let's just imagine a simple choice. You've got investment A, which is a nice, smooth ride up. Then you have investment B, which is a bumpy, all-over-the-place ride that ends up in the same spot. Which one are you going to pick? Yeah, pretty much everyone picks A, the smooth ride. This is what's called risk aversion. We just don't like volatility. And the only way you'd get someone to even consider the bumpy ride is if you offered them a higher potential payoff. As they say, there's no such thing as a free lunch. So how do we actually take these big, powerful theories and use them ourselves? It all comes down to creating your own personal blueprint. And this isn't about a one-size-fits-all formula. It's about building in a plan that's made just for you. And it starts by answering 4 simple but really powerful questions. And here they are. What are you saving for? A house in 3 years or retirement in 30? How do you really feel deep down when the market takes a nosedive? And what other financial resources do you have? Your answers to these questions are what will tell you the right asset mix for you, and only you. Let's really zoom in on your time frame for a second, because this is so important. Just look at this data. In any single year, the stock market is a complete roller coaster, right? You could be down a whopping 43% or up 54%. But watch what happens when you just stretch that out to a 10-year period. The whole picture changes. The range of what could happen gets so much smaller. In fact, the worst 10-year period saw a loss of only 1%. That's incredible. Time, it's the best tool you have to reduce risk. All right, now for the hardest question of all. The one where you have to be brutally, totally honest with yourself, your risk tolerance. And it really just boils down to this one question. When the news is screaming crash, your friends are all panicking, and your portfolio is just bleeding red, what are you going to do? Are you going to stick with your plan, or are you going to hit the sell button? This table connects that gut feeling of fear to some cold, hard numbers. Look, if seeing your portfolio drop by 43% would make you totally panic and sell everything, then you have no business being 100% in stocks. It's just not for you. But look at what happens as you start adding bonds. With a 60% stock portfolio, that worst-case drop is cut to 26%. Bonds act like a shock absorber for your portfolio, and more importantly, for your emotions, helping you stay in the game. Okay, theory is great, but let's put this all together and see what it actually looks like in the real world. Let's walk through some simple sample portfolios for different stages of your life. So, if you're a young investor, you've got time on your side, decades probably, for your money to grow and recover from any downturns. That means you can afford to be pretty aggressive. A portfolio with maybe 80% in stocks and 20% in bonds gives you huge growth potential, with just enough bonds to smooth out the ride a little. Now, fast forward a bit. As you get into middle age, you're getting closer to your big goals, like retirement. It's probably time to dial back the risk a little. The classic 60-40 portfolio is a great example. It balances the growth you still need from stocks with the stability and capital preservation you get from a bigger slice of bonds. And finally, let's say you're in early retirement. Your number one priority has shifted. It's not about growing your wealth anymore. It's about making it last and protecting it. So here, you might flip the allocation. Something like 40% stocks and 60% bonds is designed for much more stability to protect that nest egg you worked so hard to build. So let's wrap this up. Look, don't just take my word for it. The respected financial journalist Jane Bryant Quinn said it perfectly. Asset allocation is the key decision. It's not about being a stock-picking genius. It's about having a sound, simple plan and sticking to it. And here's another one. Charles Schwab, a guy who literally built an investing empire, says the exact same thing. It is the biggest factor. After all the research, all the theories, all the data, the conclusion is just so incredibly clear and consistent. Which brings us right back to where we started. You. We've cut through all the noise and focused on the one single decision that really drives your results. The financial world might want you to obsess over everything else, but you know better now. So the only question that really matters is, what is the right asset allocation for you?
All right, welcome to this explainer. We're going to dive deep into what might be the single most important, but also the most overlooked factor in your investment success, and that is costs. Look, it's not about picking the hottest stocks. It's really about what you get to keep.
So let's kick things off with this really powerful idea from the investing legend Jack Bogle. I mean, it's kind of counterintuitive, right? He's basically saying that to be a top performer, you have to be in the bottom quartile of expenses. So to be at the top, you got to be at the bottom when it comes to fees. This one simple idea, it's the key to everything we're about to unpack.
In almost every other part of life, we're taught you get what you pay for. Higher price usually means higher quality. A more expensive car, a fancier dinner, a better phone. But what we're about to see is that in the world of investing, the exact opposite is often true.
Okay, so let's dive right into this paradox. How is it possible? Why is it that paying more for an investment product, like a mutual fund, almost guarantees you'll get less back? It's a fundamental truth, and it's one the financial industry really doesn't want you to think too much about.
Just think about how different this is. When you buy a car, your money turns into a car. But in investing, every single dollar you pay in fees is just gone. It's permanently removed from your capital. That dollar can't grow for you anymore. It can't compound. It's just vanished from your pocket and put into someone else's. So where do we start our investigation? Well, let's start with the stuff that's right out in the open, the fees you can actually find listed in a fund's prospectus. But you got to think of these as just the tip of a very, very large and very expensive iceberg.
So if you look at the label, you'll see this whole menu of costs. You've got sales charges, they call them loads, which are really just commissions for the salespeople. Then there are management fees to pay the portfolio manager, these weird 12B1 fees for marketing, and a whole bunch of other administrative costs just to keep the lights on.
Okay, so all these operating costs, they get bundled together into one key number, and that's the total expense ratio, or TER. You can think of this as the official price tag for the fund. It's the percentage of your money you pay every single year. And here's the kicker. You pay it whether the fund makes money for you or not.
But, and this is a huge but, that's not the whole story. Not even close. If we stopped at the expense ratio, we'd be missing this giant piece of the puzzle. Why? Because the most damaging costs, they're the ones you can't see.
So let's go below the surface of the water now. Let's look at that big, hidden part of the iceberg. These are the costs that are not included in the official expense ratio, but trust me, they have a massive impact on your returns.
So, what's the engine driving all these hidden costs? It's something called turnover. This is just a measure of how often the fund manager is buying and selling stocks. So, 100% turnover rate, that means they've sold and replaced the entire portfolio within 1 year. And all that frantic activity, well, it creates friction. And friction creates costs. And that friction adds up in a few big ways. First, every single time the manager makes a trade, there are brokerage commissions. Simple enough. Second, they lose a tiny slice on something called the spread. That's just the little gap between the buy and sell price. And finally, and this one's a biggie, because these funds trade in such huge amounts, their own buying and selling can actually move the price of a stock, usually against them. They call that market impact.
So, when Jack Bogle's team at Vanguard added it all up, you know, the official expense ratio, plus all those hidden trading costs, plus sales charges, the whole shebang, what did they find? They found the true annual cost of the average stock fund was an absolutely astonishing 3.3%. That's more than double the official price tag of 1.6% they were telling you about.
Okay, so a number like 3.3%? I mean, it sounds small, right? But what does that actually mean for a real person over a lifetime of investing? Well, let's make this abstract idea painfully concrete. Let's look at a real-world example.
So let's meet Tad. Tad is 25 years old, he's just started his career, and he's doing everything right. He's diligently putting away $3,500 every single year for the next 40 years, saving for retirement. Now, in a perfect world, with zero costs, let's say Tad just earned the historical average stock market return of about 10.5% a year. If he did that, his savings would grow to almost $2 million. I mean, what a fantastic result, right?
But that's not what happens in the real world. We have to subtract that 3.3% in total annual costs, that constant drag from the average fund. So his real return drops all the way down to just 7.2%. And after 40 years of saving, he's left with about $788,000. That's less than half of what he could have had.
This right here, this is the devastating power of compounding costs. Look at that difference. It is absolutely staggering. Over $1 million at Tad's potential retirement money, it didn't go to him. It was just eaten away year after year after year by investment costs.
Okay, so now that we've seen the damage, let's talk about the solution, because there is some really good news here. As an investor, you have a surprisingly simple and incredibly powerful way to fight back and make sure you keep more of your own money.
There was this major study done by the Financial Research Corporation. They looked at everything people use to try and pick a winning fund. You know, past performance, those star ratings, the manager's track record, you name it. And they found that only one thing was a reliable predictor of future success. Just one. And it wasn't past returns, it wasn't celebrity manager, it was simply a low expense ratio. That's it, just the cost. And look, even the former chairman of the SEC, Arthur Levitt, has warned about this. He says don't be fooled by those small percentages. You know those little tenths of a percent here and there? They might seem like nothing, but when they compound over an entire investing lifetime, they add up to an absolutely enormous amount of your money. So here's the most important takeaway. You can't control what the stock market is going to do next month or next year. Nobody can. But you have absolute 100% control over the costs you pay. And by focusing on the one thing you can control, minimizing those costs, you give yourself the best possible chance of outperforming almost everybody else.
So what's the game plan? It's actually really simple.
Number 1, always check the price tag. That's the expense ratio. 2, lean towards things that are naturally cheap, like low-cost index funds. 3, get a feel for those hidden costs by checking out the fund's turnover rate. And number 4, just avoid all sales charges, those loads, and any other extra layers of fees. Just say no.
I want you to remember this quote from William Bernstein. He says, "Make no mistake about it, you are engaged in a brutal zero-sum contest with the financial industry. This isn't a team sport where your fund manager is your buddy. It's a contest for returns. Every single penny they pull out in fees is a penny that is lost to you forever. The way you win this game is by minimizing your costs."
So we'll leave you with this one final thought. For a long time, a lot of these costs were buried and hidden. But now you know where to look. The financial industry is charging you for its products. The only question left is, are you going to check the price tag? Because now you know how, and the power to protect your financial future is totally in your hands.
You know, when it comes to investing, we obsess over all sorts of things. Fees, market swings, trying to pick that one perfect fund. But what if I told you that the single biggest, most predictable cost that's eating away at your wealth is something most of us just kind of accept? Well, let's dive into this, because actually understanding this cost is the very first step to getting it under control.
The legendary investor Sir John Templeton absolutely hit the nail on the head with this one. I mean, think about it. It's not really about what you make, it's all about what you get to keep. That one idea, right there, is the bedrock of smart, long-term wealth building. And that's exactly what we're going to break down.
So I'll ask you straight up, do you really know what this cost is? It's not the management fees. It's not trading commissions. Nope. It's something way bigger, and it's quietly working against you year after year after year.
That's it, taxes. Just one word, but wow, what a massive impact. They're kind of like a silent partner in your portfolio, and this partner takes a cut of your success every single year. But here's the thing, and this is the important part. Unlike market chaos, this is one cost you can actually do something about.
To really get why this matters so much, we gotta look at the numbers. Let's pull back the curtain on the long-term damage that this tax drag, that's the amount your returns get knocked down by taxes, can do to your portfolio. And trust me, the results, they might just shock you.
The difference here is just staggering. Check this out. A study from Charles Schwab looked at what happens to $1 over 30 years. In a tax-deferred account, it grew to almost $22. Pretty great, right? But that same dollar in a regular taxable account, it grew to less than 10. It was more than cut in half simply because of that annual tax bite. This just perfectly shows you the corrosive power of taxes over time.
So how does that even happen? Well, a study by the legend himself, Jack Bogle, found that the average equity fund loses about 1.7% of its return to taxes every single year. Think of it like this. It's a hidden extra fee that you're paying directly to the government. It's a constant drag on your performance.
Okay, so that's the bad news. I know, it's a little depressing. But here's where the story gets good. You can't control what the market does tomorrow, right? But you absolutely 100% can control how much you give away in taxes. And that's where the real power is.
So if we're going to start controlling this cost, we first have to understand how our funds are even generating a tax bill. It really all comes down to two things: dividends and capital gains. Let's break down how they're treated, because they are not the same.
All right, the first rule of being a tax-savvy investor is super simple. Patience pays. When a fund sells something it held for a year or less, that profit is a short-term gain. And you get taxed on it at your highest income tax rate. Ouch. But if it holds for more than a year, it becomes a long-term gain, which gets taxed at a much lower rate. That gap between those two rates is exactly why patience literally pays off.
And it's pretty much the same story with dividends. See, not all of them are created equal. You've got qualified dividends, the kind you get from most U.S. stocks, and they get that nice lower tax rate. But the interest from bonds, which gets paid out as a dividend, gets taxed just like your regular income. And that's a huge reason why stocks are often a way better fit for your taxable accounts than bonds are.
Now, if you want a real horror story, look no further than this. A physician puts $50,000 into a fund. Just 7 weeks later, the fund pays out this massive capital gains distribution. So even though his own investment hadn't really gone anywhere, he suddenly owed almost 10 grand in taxes. Why? Because he unknowingly inherited all the built-up gains from the fund's trading that happened before he even invested. It's what we call a tax bomb, and it's a classic rookie mistake.
That tax bomb story brings us to a really critical idea that, honestly, most investors completely overlook: a fund's turnover rate. You can think of this as the hidden engine that's driving your tax bill, and understanding it is absolutely key to protecting your returns.
So how does low turnover help? Well, a fund with a low turnover rate is just one that doesn't buy and sell stocks all the time. The benefits are huge, and they're twofold. First off, fewer sales simply means fewer taxable gains are being created and passed along to you. And second, the sales that do happen are way more likely to be on investments held for over a year, meaning they qualify for those sweeter, lower long-term tax rates. It's a win-win.
Okay, we've diagnosed the problem. We know exactly how taxes are chipping away at our wealth. Now for the fun part, the solutions. Let's talk about the practical strategies you can actually use to build a truly tax-efficient portfolio. This first idea is called asset location, and it is incredibly powerful. The concept is pretty simple. You want to put your least tax-efficient investments, we're talking high turnover funds or those taxable bond funds, inside your tax-sheltered accounts, like a 401k or an IRA. This shields all that inefficient income. Then you keep your most tax-efficient stuff, like low-turnover index funds, in your regular taxable brokerage account.
Another awesome tool in the toolbox is something called a tax-managed fund. Now, unlike most funds where the managers only care about pre-tax returns, these funds have one primary goal: maximizing your after-tax return. They are built from the ground up to be tax-savvy.
So how do they do it? Well, they've got a whole toolkit of strategies. They'll strategically sell losers to offset the winners. That's called tax loss harvesting. They'll be careful to sell the highest cost shares first to keep profits low. And of course, they make it a huge priority to hold things for over a year to get those preferential long-term capital gains rates. They even tend to focus on low dividend stocks to keep your annual tax bill down.
Now, the great thing is, you don't have to rely only on these special funds. You can apply these exact same principles to your own portfolio. So let's get into the actionable steps you can start taking, like today. Okay, here's your game plan. Step 1, keep your own turnover low. Just adopt a buy and hold mentality in your taxable accounts. Step 2, use tax-efficient funds, like broad market index funds. Step 3, discipline yourself to hold on to your winners for at least a year and a day. And finally, the big one, make a habit of harvesting your tax losses.
Let's just focus on that last point for a second: tax loss harvesting. All it is the simple act of selling an investment that's down in value. By realizing that loss on paper, you create a tax deduction, and you can use that deduction to completely wipe out taxes on your investment gains and even reduce your regular taxable income by up to $3,000 a year. It's a game changer.
Let's just walk through a quick example to make it crystal clear. Imagine you've got a $2,000 gain from one fund, but another fund you own is down $6,000. Before the year ends, you sell the loser. You use $2,000 of that loss to completely erase the tax on your gain. Poof, gone. Then you use another $3,000 to lower your regular taxable income, and you still have $1,000 in losses left over to carry forward to next year. See? You've just turned a losing investment into an incredibly powerful tax-saving tool.
And this really brings us right back to the core message of all of this. We spend so much time and energy trying to predict the unpredictable market, but the real, tangible gains often come from just diligently managing the things we can control. And the biggest controllable of all is the tax bill on your investments. At the end of the day, you're the one in the driver's seat here. You control the tax efficiency of your portfolio. So the real question isn't whether you can lower your investment tax bill, it's how you're going to start. What's the first move you're going to make?
All right, let's talk about something that is absolutely critical if you're serious about growing your money: tax-advantaged investing. We're going to break down how you can actually keep more of what you earn and build a way bigger nest egg for yourself, all based on some brilliant insights from the Bogleheads Guide to Investing.
You know, this quote from the Vanguard group really just hits the nail on the head. We spend so much time worrying about stock picks and management fees, but there's this invisible force that can do way more damage to our returns than anything else, and that's taxes. They are, without a doubt, the single biggest threat to your long-term growth.
So, that's the million-dollar question, right? If taxes are coming to take this huge slice of your pie, how do you stop them? How do you protect your plate? Well, that is exactly what we're going to figure out. Think of this as your playbook for defending your investments.
So how do we fight back against this opponent?
Well, the good news is you're not in this alone. The government has actually created some special tools, these tax-sheltered accounts, to help you save. And that's exactly where we're going to start.
For most of us, the very first and probably the easiest tool to get our hands on is the one offered right at work. I'm talking about your workplace retirement plan, which you probably know as the 401k.
So what is a 401k, really? In simple terms, it's a special account where you get to save a chunk of your salary before the government even gets a chance to tax it. Right off the bat, that move lowers your taxable income for the year. That's a pretty sweet deal.
And the perks? Oh, they are fantastic. Your contributions are automatic, you can save a lot more than in other accounts, and you can take it with you if you switch jobs. But the real MVP, the undisputed champion of 401k perks, is the employer match. Seriously, if your company offers a match, it is literally free money. There is no other investment on planet Earth that gives you a guaranteed 100% return on day one.
Okay, but it's not all sunshine and roses. A lot of 401k plans have some pretty big downsides. We're talking about surprisingly high fees, a really limited menu of investment options, and not a lot of flexibility. This is why just setting it and forgetting it might not be your best move.
And this is where it gets a little sneaky. The real danger here is the hidden costs. Most people don't even see these fees because they're just quietly siphoned off your returns. You've got fees for administering the plan, fees for the investments themselves, even fees for things like taking out a loan. And over 30 or 40 years, those tiny little percentages can add up to a fortune.
So what if your 401k is kinda crummy? High fees, terrible options, what's your next move? Well, that brings us to the Individual Retirement Account, or IRA. This is where you get to take the wheel and choose from pretty much any investment under the sun.
Now, with an IRA, you've got this one fundamental choice to make. It really boils down to a simple question. Do you want to pay taxes now, or do you want to pay them later? With a traditional IRA, you get a tax break today, but you'll owe taxes when you take the money out. With a Roth IRA, it's the opposite. You pay your taxes now, and then your withdrawals in retirement are 100% tax-free.
Let's just walk through the big differences here. Can you deduct your contributions? Well, with a traditional, maybe, if your income isn't too high. With a Roth? Nope, never. Are you forced to take money out when you get older? With a traditional, yes. The government wants its tax money eventually. But with a Roth? Nope, not if you're the original owner. And then the big one, how does the money get taxed on the way out? Regular income for the traditional, but completely tax-free for the Roth. Big difference.
So, who is the traditional IRA for? Well, it all comes down to where you think your tax rate is going. If you're pretty sure you'll be in a lower tax bracket when you retire than you are right now, the traditional is a fantastic choice. You get the tax deduction today when your rate is high, and you pay taxes later when your rate is low. Simple as that.
But the Roth? Oh man, the Roth is a powerhouse. Especially if you think your tax rate might be the same or even higher in retirement. By paying those taxes today, you're locking in a future of tax-free growth and tax-free withdrawals. It's an amazing deal, and it's also incredible for passing wealth to your kids.
Okay, so you've picked your accounts, you're making your contributions, you're feeling good. But now we get to the secret sauce, the real pro-level strategy. In this next section, we're going to talk about a single decision that could be worth over $100,000 to you in the long run.
And here it is. The big secret isn't just about what stocks or bonds you pick. It's about where you put them. It's a concept called asset location, and it's all about strategically placing your investments in the right type of account to squeeze out every last drop of after-tax return.
So let's run the numbers, just like in the book. Here's the rule. You want to put your most tax-inefficient investments, like bonds, inside your tax-protected accounts like a 401k or an IRA. When you do that with this simple $100,000 portfolio, check out the result. After 30 years, your after-tax value is over $1 million. Okay, now let's see what happens if we get it backward. What if we do the opposite and put the tax-efficient stocks inside the tax-deferred account? This is a super common mistake. Well, look at the final number. That same portfolio, same time frame, ends up being worth just about $886,000 after taxes. So what's the difference between doing it the right way and the wrong way? It's $119,000. Let that sink in for a second. We're talking about the exact same investments over the exact same period of time. The only difference was where you held them. That is a life-changing amount of money, and it's the power of smart asset location.
Okay, wow. That was a lot, I know. So let's bring it all home. Let's wrap this all up into a simple, actionable checklist you can use to make sure you're on the right track.
First things first, and this is non-negotiable. Put enough in your 401k to get the full company match. Don't leave free money on the table. Second, make that call between a traditional and a Roth IRA based on your best guess about your future taxes. Third, that big one we just talked about, practice smart asset location. Put the inefficient stuff like bonds in your retirement accounts and the efficient stuff like stock funds in your regular brokerage accounts. And hey, here's a bonus pro tip. If you ever have a low-income year, that is a golden opportunity to convert some of that traditional IRA money over to a Roth.
And that really brings us to the whole point of this. It's one thing to know all the rules of the game. It's a completely different thing to actually make the plays on the field. So the question I want to leave you with is this. Now that you know the rules, are you making the moves that are going to have the biggest impact on your future?
There's this one single investing mistake that has wiped out fortunes, derailed retirements, and even brought down giant corporations. Today, we're going to pull back the curtain on that mistake and, more importantly, on the powerful strategy to stop it: diversification. It's really the art of not losing everything. Let's dive in.
Remember Enron? Back in 2001, this company was a Wall Street darling, an energy giant. And then, poof, it collapsed in a massive scandal. Now for the employees, it was a double tragedy. Imagine this. You don't just lose your job. You lose your entire retirement savings because it was all tied up in company stock that was suddenly worthless. Just devastating.
And, this wasn't just a one-off thing. Just a year later, another giant, WorldCom, went down a very similar path. And again, you had employees who did what they thought was the right thing, investing in the company they worked for, only to see their life savings just evaporate, along with their jobs.
Or hey, let's rewind to the dot-com mania. This was a classic fear of missing out, right? FOMO on a massive scale. Investors were convinced they'd found a sure thing and just poured everything they had into these hot tech stocks. And for a minute, yeah, they were millionaires on paper. But when that bubble burst, wow, most of those companies just vanished, and a lot of people had to push off their retirement for decades.
All of these stories, Enron, WorldCom, the dot-com bust, they all boil down to this one simple, timeless piece of advice. It's a saying we've all heard a million times, but when you ignore it, the consequences can be absolutely life-altering.
So in our first section, we're looking at these cautionary tales, because they're not just stories, right? They are powerful, real-world lessons about what happens when you put all your risk in one single place. Okay, those stories are pretty grim, I know, but they point us directly toward the solution. So how do we protect ourselves from that kind of financial nightmare? Well, the answer lies in a really simple but powerful idea I like to call the zig and the zag.
So what is diversification really? I love how Warren Buffett puts it. He says it's protection against ignorance. And that's so true. Since none of us has a crystal ball, we can't possibly know which company is going to fail next. So diversification is just the simple strategy of spreading our money around so that one bad apple doesn't spoil the whole bunch.
And this slide, this is the whole idea in a nutshell. It's so simple. You want to own different things that don't all move in the same direction at the same time. So when one part of your portfolio is zigging up, another part might be zagging down a bit. And it's that interplay, that balance, that smooths out the whole journey and protects you from those wild, scary swings.
And this leads to two huge benefits. First, the obvious one. It reduces your risk. You avoid that whole all your eggs in one basket problem. But the second one, and this is kind of mind-blowing, is that it can actually increase your return over time. How? By helping you avoid those catastrophic losses while still letting you catch the upside from all different parts of the market.
Okay, so the theory makes sense, but how do we actually do this? How does this translate into a real-world portfolio? Let's get practical and figure out what a properly diversified strategy really looks like.
You've probably heard this before, right? For a long, long time, people believed that if you just owned, say, 20 or 30 different stocks from different industries, you were all set. You were diversified. But is that still true today?
Well, according to financial author William Bernstein, the answer is a big, loud no. I mean, this quote just completely shatters that old way of thinking. In today's global interconnected economy, just owning a few dozen stocks, it doesn't even come close anymore.
So, this is the key takeaway here. If a handful of stocks isn't enough, then what is? Well, the modern gold standard for diversifying with stocks is to own everything, the whole market.
That way, you're not betting on one company or even 100 companies. You're betting on the entire economy to grow over time. Now, don't panic. You don't have to go out and buy thousands of individual stocks. That would be a total nightmare, not to mention expensive. The easiest way to do this is with a single low-cost mutual fund, like a total stock market index fund. One purchase and you own a tiny piece of pretty much every public company out there. And then to really take it to the next level, you add another layer entirely, bonds.
So why bonds? We're right back to our zigzag principle. History shows us that when the stock market is having a rough time and zigging downwards, the bond market often zags up, or at least holds steady. It's like a shock absorber for your portfolio, a cushion for those turbulent times.
Okay, this brings us to the actual science, the magic, if you will, that makes this all work. It's a concept called correlation, and it's the engine that powers diversification. Now, correlation coefficient sounds super technical and boring, but I promise the idea is really simple. It's just a score from -1 to +1. If the score is +1, it means two investments move in perfect lockstep. If one's up, the other's up. If it's -1, they're perfect opposites. And if the score is 0, it means their movements have absolutely nothing to do with each other.
And this is exactly what we're aiming for. See on the left, high correlation? That's no good. If one investment tanks, the other one's probably going down with it. Not much help there. What we want is over on the right, low correlation. We want investments that are doing their own thing, moving independently. That's the real key to a smooth ride.
Let's look at a real-world example. On this slide, you'll see a number called R². Just think of it as a practical way to see correlation. A number close to 1 means they're basically moving together. And look at this, a Vanguard 500 fund and a total stock market fund. Their R² is pretty much 1.00. They are nearly identical. Owning both doesn't diversify you. It's like owning 2 copies of the same book and thinking you have a library.
Okay, but now, check this out. This is where the magic really happens. The correlation between a total stock market fund and a total bond market fund is just 0.10. And between a real estate fund and a bond fund, it's even lower. This is what we want. These things do not move together, and that gives you a massive diversification benefit.
So at the end of the day, the big takeaway from all this sciencey stuff is simple. When you're thinking about adding something new to your portfolio, the #1 goal is to find something that has a low correlation to what you already own. That's it.
Okay, I know we just threw around terms like R² and correlation, and it might seem a little complex. But here's the really good news. You do not need a PhD in statistics to do this right. Let's boil this all down to a super simple, actionable plan that literally anyone can follow.
Honestly, there are 2 fantastic, low-cost ways to nail this. First, you can build it yourself with just 2 or 3 simple funds. Get one for US stocks, one for international stocks, and one for bonds. Bam, you're done. Or, if you want the ultimate easy button, you can just get an all-in-one solution, like a target retirement fund. These things are designed to do all the work, all the diversification, all the rebalancing for you, automatically.
So I'm going to leave you with this question to think about. Is your portfolio really prepared to both zig and zag? Take a quick look at what you own. Is it truly diversified, or are you maybe a little too exposed to those big risks we talked about at the beginning? Because building a portfolio that can handle the market's ups and downs, that is the true art of not losing everything.
Let's be honest, we all love picking a winner. It doesn't matter if it's a sports team or a stock, that instinct to just bet on the one with a hot hand is so powerful. But what if I told you that in the world of investing, that exact instinct is probably the most dangerous mistake you can possibly make? You gotta love this quote from Will Rogers. It's hilarious, right? But it also perfectly nails the simple logic so many of us try to use when we invest. Just find something that's going up and buy it. I mean, it seems like a total no-brainer. And that, right there, is the whole idea behind what we call performance chasing. And this isn't some fringe idea, not at all. A study from the Investment Company Institute found that a jaw-dropping 75% of mutual fund investors say that short-term past performance is their #1 reason for buying a fund. Think about that. 3 out of every 4 people are trying to drive their financial future forward by staring directly into the rearview mirror. So, that brings us to the big question for this whole explainer. If picking last year's winners feels so right, so intuitive, why does all the data, and I mean all of it, show that it's a terrible strategy? Let's dig in and find out. Okay, first things first. We have got to bust the biggest myth in investing, and that's this idea of a sure thing. You know, the belief that a fund that had an amazing year last year is just destined for greatness again this year. The real story? Well, it's a lot different. And, you know, the financial industry makes it incredibly easy to fall for this myth. They've got rating systems for everything. The most famous one is probably Morningstar, right? They hand out their coveted 5-star rating to the top 10% of funds, all based on how well they've done in the past. It's basically packaged and sold as a shortcut to finding the absolute best. So it seems pretty obvious then. The secret to getting rich must just be to load up your entire portfolio with these 5-star funds. Sit back and wait for the cash to roll in. Problem solved, right? Well, whoa, not so fast. Take a look at this. The data here is kind of shocking. Mark Holbert, a guy who tracks this stuff like a hawk, found that over a recent 10-year period, these supposedly elite 5-star funds returned an average of just 5.7%. The rest of the market, the whole thing, returned 10.3%. That is a huge difference. The so-called best funds weren't even average. They were way, way below. And it's not just one study. A paper from the University of Amsterdam found that these fund ratings are no better than a random walk, which is just a fancy way of saying you might as well flip a coin. Vanguard did a study and found that out of the top 20 funds from one decade, only one, just one, even managed to stay in the top 100 the next decade. And here's the ultimate example. The 44 Wall Street Fund. It was the #1 absolute best fund of the entire 1970s. Then, in the 1980s, it became the single worst performing fund. Talk about a fall from grace. All right, so if chasing the hot funds is a dead end, what about trying to outsmart everyone? You know, trying to jump in right before the market goes up and then cash out just before it crashes. Ah, yes, the beautiful, tempting, and oh so dangerous idea of market timing. The Motley Fools have the perfect definition for it. It's a strategy based on predicting short-term price changes. And I love that they add the spoiler alert right there in the definition. It's virtually impossible to do. Let's look at why that is. Check out this real-world example. It's wild. The Granville Market Letter had a monster year in 1991, a 245% return. So you put in 10 grand, and now you have $24,500. Awesome! But then, the very next year, it loses 84%. Now you might think, 245 minus 84, I'm still way up. But that is not how the math works. An 84% loss on your bigger pile of money leaves you with just over $3,900. You didn't just give back your games, you ended up losing 61% of your original investment. And if you think that's just some abstract example, let's talk about the so-called experts. Get this. A newsletter guy named Doug Fabian was so sure he could time the market that he publicly invested $500,000 of his own money to prove his system worked. The result? He lost $192,000. He later said the loss was worth it for the lessons he learned. I'm sure his followers would have preferred a slightly cheaper lesson. Or what about Wall Street Week, the most popular financial show on TV for decades? They had this panel of 10 market timing gurus they called the Elves. And their track record was, well, it was hilarious. They were bullish right at the market top in 1990 and bearish right at the bottom. They were bullish all the way down during the crash of 98. And my favorite, they were all bullish just 2 months before the massive 3-year bear market kicked off in 2000, consistently wrong at every single major turn. I think Jack Bogle, the guy who founded Vanguard, really puts the final nail in the coffin. After basically a whole lifetime in this business, he said he doesn't know a single person who has ever timed the market successfully and consistently. And he went on to say he doesn't even know anyone who knows anyone who has. I mean, if that doesn't tell you everything, I don't know what will. So, if chasing winners is a losing game and trying to time the market is a myth, what in the world actually works? The answer is almost ridiculously simple, but it is incredibly powerful. It all comes down to just staying the course. Okay, now check out this slide. This is from a huge study by Professors Odian and Barber. They looked at the real-life brokerage accounts of over 66,000 investors, and what they found was amazing. The most active traders, the people buying and selling all the time, they earned about 11.4% a year. The average person did better, at 16.4%. But the people who traded the least, the ones who just bought good investments and held on, they earned 18.5%. They did better by doing less, a lot better. So here it is. Here's the big secret. Winning in investing isn't about being a genius and making these brilliant, perfectly timed moves. No, it's about having the discipline to avoid the dumb moves. It's about not chasing that hot fund and not panicking and selling everything when the market gets a little scary.
And everything we've just talked about, it gives you a kind of superpower, and is one of the most valuable you can have in finance. It's the ability to just tune out all the noise.
You have to realize that Wall Street and the financial media, they have a business model. And that model depends on you getting excited or scared and doing something. They need noise, they need hype, they need activity to make money. But your long-term financial success, that depends on the exact opposite. It depends on you ignoring almost all of it.
Let's wrap this up with a little wisdom from some of the investing giants. First up, Warren Buffett, who famously said that in a world that is obsessed with action, inactivity strikes us as intelligent behavior.
Here's Jack Bogle again, just hammering this point home. Stay the course. It is the most important single piece of investment wisdom I can give to you. He said he repeated it 1,000 times because it is the one thing that actually truly works. And finally, from the father of value investing himself, Benjamin Graham. After 60 years on Wall Street, the main thing he noticed was that people just plain cannot predict what the stock market is going to do. Period.
So I'll leave you with this final question. Now that you've seen the data, now that you know that chasing performance doesn't work and that the smartest move is often to just do nothing, can you do it? Can you resist that powerful emotional urge to act the next time the headlines are screaming and the market gets noisy? Because your answer to that one question might be the biggest factor in your financial success.
Okay, let's talk about saving for college. You know, it's one of those goals that can feel, well, a little overwhelming, right? But it's also hands down one of the most important investments you can make for your kids. So in this explainer, we're going to break down all the smartest ways to save so you can build a plan and feel really good about it. I love this quote from Bill Vaughan. It's kind of funny, but it really nails it, doesn't it? It's a humorous little jab at a very serious topic, just how valuable a college education really is. And that value, that's exactly what we're going to unpack. So what's a college degree actually worth in dollars and cents? Well, according to the U.S. Census Bureau, the magic number is about $1 million. Yeah, you heard that right. That's roughly how much more college grad can expect to earn over their career compared to someone with just a high school diploma. We're talking about a life-changing amount of money. And that, right there, is why this conversation matters so much. All right, here's our game plan. First, we're going to dig a little deeper into that $1 million number. Then, we'll walk through the different savings options out there, starting with the classic choices and then moving into the really tax-savvy plans. After that, we'll touch on a few other specialized tools, and finally, we'll help you figure out how to choose the right path for you. So let's start with the big picture, because saving for college, it's not just about writing a check for tuition. It's truly about investing in your child's entire financial future. And as you're about to see, the return on that investment is, well, it's huge. This chart really says it all, doesn't it? Look at that. A high school diploma might get you around $1.2 million in lifetime earnings. Not bad, but look what happens with a bachelor's degree. That number jumps up to $2.1 million. And a master's, $2.5 million. The message could not be clearer. Education pays off big time. Okay, so you're convinced. But where on earth do you even start? Let's look at some of the most common foundational ways to save for college, starting with the absolute basics. You know, the most straightforward path is simply a personal savings or investment account. It's your money, in your name, and you are in complete and total control. Think of this as your savings home base. And the biggest advantage here is just pure flexibility. You're in the driver's seat. What if your kid gets a full-ride scholarship? Awesome! You can use that money for something else entirely. There are no limits on how much you can put in, and you can use the funds for any of your kids. It's your money, and you make all the rules. Now, another very popular option is something called a custodial account. You'll hear it called a UGMA or UTMA. Basically, this is an account you set up specifically for a minor. It's a great way to earmark money just for them. But, and this is a huge but, there's a catch, a really big one. The moment your child turns 18 or 21, depending on your state, that money is legally theirs, all of it. And they can do whatever they want with it, college tuition or a brand new sports car. You no longer have a say. And that's not the only potential problem. Custodial accounts can actually hurt your child's chances of getting financial aid. Why? because the money is considered their asset, not yours. And financial aid formulas expect students to contribute a much bigger chunk of their assets toward college costs. That can seriously reduce the amount of aid you're offered. Okay, so if you're thinking, I want more control and I'd love some better tax breaks, then you really need to look at a 529 plan or a Coverdell ESA. These are specialized plans designed from the ground up just for education. Remember that huge control issue we just talked about with custodial accounts? Well, 529 plans completely solve that problem. With a 529, you, the parent or grandparent, are the account owner. You always remain in control of the money. No surprise sports cars. So what exactly is a 529 plan? Think of it like a supercharged savings account built for education. Your money grows tax-deferred, and then you can withdraw it completely tax-free for all those qualified education expenses. There are two main flavors: savings plans and prepaid tuition plans. And the benefits of a 529 are fantastic. There are no income limits on who can contribute, and the contribution limits are massive. Like we said, you're always in control. And hey, if one kid decides not to go to college, you can just change the beneficiary to another family member. It's no wonder these things are so incredibly popular. All right, another great tax-advantaged option is the Coverdell ESA. Just like a 529, it gives you tax-free growth and tax-free withdrawals. But here's the key difference. You can use the money for K-12 expenses too, not just for college. Things like private school tuition or tutoring. But there are definitely some strings attached here. You can only put in $2,000 a year per child, which isn't a lot when you're thinking about college costs. And there are income limits on who can even contribute. So while a Coverdell can be a great tool for those earlier K-12 years, it's probably not going to be your powerhouse for saving the full cost of a 4-year degree. Now that we've covered the big three, personal savings, custodial accounts, and the tax-advantaged plans, let's take a quick look at a couple of other options you might want to have on your radar as part of your overall strategy. U.S. savings bonds. These are a super safe, very conservative way to save. The big draw is that the interest you earn can be tax-free, but only, and this is a big only, if you use the money for education and follow a few very specific rules. And when I say the rules are strict, I mean they are strict. The bond has to be in your name, not your child's. You have to meet certain income requirements in the year you actually cash it in, which is kind of tough to predict 18 years down the road, right? So while it's safe, it's definitely not the most flexible tool in the shed. You can also tap your IRA for college expenses and avoid that early withdrawal penalty. But, and please listen closely here, this should be your absolute last resort. I want you to remember this one thing. You can borrow for college, but you can't borrow for retirement. Always make sure you're taking care of your own future first. Yeah, okay, so we've laid out all these different options. With all these choices, how in the world do you figure out which plan is right for you? Let's boil it down and look at the key differences to help you decide. This chart right here is basically your cheat sheet. If you just look at that first row, control, you see it right away. With 529s and Coverdells, you, the parent, stay in charge. With the custodial account, control goes to the child. Now jump down to contribution limit. If you're looking to save a serious amount of money, the 529 is the clear winner with its super high limits. It all comes down to what you value most. Look, there's no single best answer here that fits everyone. The best plan is the one that works for you, for your goals, and for your family. It's about finding the right balance of control, flexibility, and tax savings for your own journey. The most important thing? Just get started. Thanks so much for tuning in.
So, picture this. A huge sum of money just lands in your lap. Out of nowhere. It's a windfall. And yeah, it's probably more money than you've ever seen in your entire life. It sounds like an absolute dream, right? But it can also be surprisingly tricky. So let's dive into how to manage it the right way. Woody Allen really hit the nail on the head, didn't he? We've all had that fantasy of a sudden pile of cash that just solves everything. But you know, what happens when that fantasy actually becomes your reality? The truth is, without a solid plan, a windfall can create a whole new world of problems.
Now, you might think windfalls are just for lottery winners or big-shot athletes, but the reality? Millions of people get them every single year from totally normal life events. You know, selling a house, getting an inheritance, or even a massive bonus at work. Over a lifetime, there's actually a pretty good chance it could happen to you.
But here's the part that should really make you sit up and pay attention. According to NBC News, a staggering 70% of lottery winners blow through their entire fortune in just 3 years. Let that sink in. 3 years. That statistic alone shows you the hidden danger lurking behind sudden wealth.
And that right there brings us to the heart of the issue, what we call the windfall paradox. It's this constant battle between the dream of total financial freedom and the very real danger of losing every single penny.
What's so interesting about all this is that the biggest challenge you'll face isn't really financial, it's psychological. All that money can set off this huge emotional storm inside you, and learning to navigate those feelings, well, that's step one to making smart decisions.
It's a total roller coaster. One minute you're feeling ecstatic, and the next you could be dealing with depression. That amazing sense of freedom, it can get replaced by incredible stress and even paranoia. I mean, think about a business owner who sells their company. They might feel relief, sure, but also a complete loss of who they are. These feelings are totally normal, but they are the worst possible foundation for making massive, life-changing decisions.
This is exactly what's going through your head. I'm not ready for this. Who can I possibly trust? What am I supposed to do now? It's that feeling of being completely and totally overwhelmed. And if you ever find yourself there, you have to know that this anxiety is the universe screaming at you to just slow down.
So how do you get through this storm? Well, you do it with a simple, actionable plan. I want you to think of it like a 4-step safety net. It's designed to give you clarity and control right when you need it the most.
And here it is. This is your roadmap. First, you're going to hit pause. Then, you get a reality check. After that, you create your wish list. And finally, you get professional help. All right, let's break each one of these down.
Okay, the single most important secret, and I cannot stress this enough, to holding onto a windfall is to not touch it for at least 6 months. Just deposit the money into a safe, boring, easy-to-access account like a high-yield savings account and just let it sit. This creates a cooling-off period, and it lets all those intense emotions die down before you make any huge decisions.
And yes, this means you have to resist all those immediate temptations. Do not quit your job. Do not buy the mansion or the flashy sports car. Don't start handing out loans to every friend and cousin who comes calling. For now, your only goal is to keep living your life exactly the way you did before the money showed up.
Okay, so 6 months have passed. You're feeling a lot calmer. Now it's time for step 2, the reality check. This is where we move past that illusion of I have endless money and get a firm grip on the actual numbers.
Let's use an example. Let's say our friend, we'll call him Joe Fortunate, gets a $1 million windfall. To him, that number feels infinite. It's a lottery ticket to a brand new life, right? But here comes the first dose of reality. Is Joe really a millionaire? Not after taxes. Depending on how that money is taxed, he might only have $600,000 left. And suddenly that number feels, well, a whole lot different.
Now for the most important number of all. If Joe wants his money to last and to keep up with inflation, financial planners often suggest withdrawing only about 4% a year. Well, 4% of $600,000 is $24,000. Now, look, that's a fantastic income supplement for sure, but it is not quit your job and buy a yacht money. And that one simple calculation, it changes everything.
So once you understand what the money can realistically do for you, then you get to move on to the fun part, deciding what you actually want to do with it. This step is all about shifting your mindset from just protecting the money to actively using it to build the life you truly want. It is time to dream, but with a little structure. What do you want your life to look like right now? What about in a year, or 5 years, 10 years down the road? Writing it all down is what transforms those vague fantasies into a concrete set of goals you can actually start working towards. All right, you've got your planning and you've got your goals. Now it's time for the final and absolutely critical step. You do not have to figure out all the complex details by yourself. It's time to build your dream team. But hold on. Before you hire anyone, you need to ask one crucial question. Are you talking to an objective advisor or are you talking to a salesperson? See, a lot of so-called financial professionals are really just salespeople who make commissions on the products they sell you. This creates a huge potential conflict of interest. What you need is objective, unbiased advice. So where do you even start? A fantastic first phone call is to a certified public accountant, or a CPA. And here's the key part. One who does not sell investment products.
You pay them an hourly rate for their time and their expertise, not for pushing you into a certain mutual fund.
A good CPA can basically be the quarterback of your new financial team. They'll help you figure out the taxes, they'll look at your whole financial picture, and they'll tell you if you need other experts, like an estate planning attorney. They bring that crucial objectivity when you're surrounded by all sorts of noise and bad advice.
And that's the four-step plan. You know, it can all seem a little overwhelming, but let's be real here. A windfall is a very nice problem to have. With a clear head and a solid plan, it's not a crisis, it's an absolutely wonderful opportunity.
So I'll leave you with this question. After you've taken 6 months to just pause and you've gotten that reality check on the numbers, what's the first real, tangible dream you would put on your wish list? Because knowing the answer, well, that's the first step to actually making it happen.
You know, choosing someone to manage your hard-earned money, it's one of the biggest financial decisions you'll ever make. But let's be real, in a world of confusing titles and hidden fees, how do you find someone you can actually trust? Well, let's dive in and unpack how you can find a great advisor and, just as importantly, avoid the common pitfalls. Wow. This quote is a little dark, isn't it? But it cuts right to the heart of the problem we're talking about today. It highlights this massive built-in conflict of interest that can exist between you and the person who's supposed to be giving you advice. It's a pretty stark reminder that sometimes their financial success can come directly at your expense. And this just brilliantly illustrates how that conflict works. There's this old saying that used to go around among some brokers. When a client buys or sells, the broker and the brokerage make money. 2 out of 3 ain't bad. I mean, think about that for a second. It reveals a kind of shocking truth. The system is often set up so the advisor and their firm get paid for every transaction, whether your investment actually works out for you or not. Okay, so let's just call it what it is. The fundamental conflict in financial advice is that many advisors are paid in a way that encourages them to act in their own best interest, not yours. Their paycheck is tied to selling you something, not necessarily to making you wealthy in the long run. So what happens because of this conflict? Well, a lot of investors end up getting pushed into expensive mutual funds with these high sales charges, sometimes called loads. Or they get sold really inappropriate products like certain annuities that they just don't need, all because those products generate big, fat commissions for the advisor. So, as if the payment stuff wasn't confusing enough, there's another major hurdle, the insane mess of professional titles. It's a true alphabet soup out there, and a lot of it seems designed to impress you, but really, it just leaves most people feeling confused. So here's a really critical question. Can just anyone print up some business cards and call themselves a financial advisor? The answer, maybe shockingly, is yeah, pretty much. And this is exactly where so many people get into trouble. And this slide right here just lays it all out. Look at the contrast. On the left, you've got these generic-sounding titles like financial consultant. According to the SEC, these titles require absolutely no special education, no testing, no certification. You could literally just print a business card. But on the right, you have designations like CFA and CFP, which represent years of hard, rigorous work and proven expertise. And just to give you a sense of how confusing this all is, FINRA, that's the Financial Industry Regulatory Authority, they list nearly 150 different professional designations in their database. 150. It's completely overwhelming. So how are you supposed to figure out which ones actually matter? Well, let's talk about what real expertise looks like. To earn the Chartered Financial Analyst, or CFA designation, you are looking at a massive commitment. We're talking about 750 hours of study to pass 3 absolutely grueling multi-year exams. And that's on top of already having a degree and years of professional experience. Having a CFA charter is a huge signal of deep expertise. And it's the same story for the Certified Financial Planner, or CFP designation. It is just as demanding. A candidate has to master over 100 different financial topics. I mean, everything from insurance and taxes to retirement and estate planning, and then pass a huge exam. So here's the bottom line. When you see letters like CFA or CFP after an advisor's name, you know those letters actually mean something. They've been earned. Okay, this right here is probably the most important part of this whole thing. Forget the fancy title for a second. The single most important question you can possibly ask an advisor is simply, how do you get paid? The answer to this one question reveals just about everything you need to know about their motivations. First up, we have the commission-based model. Think of this person as a salesperson, plain and simple. They get paid to sell you products. This creates a massive conflict of interest, right? They have a financial incentive to recommend the fund that pays them the biggest commission, not the one that's actually best for you. The advice from seasoned investors is pretty blunt and simple here. Just say no thanks.
All right, now this next one, fee-based, is where things get really tricky. The term is kind of designed to be confusing. It often means the advisor charges you a fee and they collect commissions. In the worst-case scenarios, this can drain up to 4% of your assets every single year. So if an advisor tells you they're fee-based, you have to dig deeper. You have to ask, do you also receive commissions? It's a critical question.
And that brings us to the one you're really looking for, fee only. This is the gold standard. It's the most transparent model out there. You pay the advisor directly, maybe an hourly rate, a fixed fee, or a percentage of your assets. And because their only payment comes from you, their interests are aligned with yours. This structure means they can act as a fiduciary, which is just a fancy way of saying they are legally required to act in your best interest.
So why are we hammering on about fees so much? Well, the legendary investor Jack Bogle, founder of Vanguard, he put it perfectly. He said that while figuring out your mix of stocks and bonds is crucial, the cost you pay is just as important. Think about it. Every single dollar you pay in fees is a dollar that isn't growing and compounding for your future. It's that simple, and it's that powerful.
Okay, so we've covered a lot. We know the problems, we know what to look for. So now let's boil this all down into a super simple, actionable checklist you can actually use to check out any potential advisor. And this is all based on recommendations from the U.S. Securities and Exchange Commission, the SEC.
All right, first up, define your needs. Before you even talk to anyone, figure out what you want. Do you need a full-blown financial plan or just help managing investments? Knowing this will save you time and money. Second, interview multiple candidates. Don't just go with the first person you meet. Treat it like a job interview because you are the one doing the hiring. Third, and this is the big one, ask them directly how they get paid. Use the terms we just learned. Are you fee-only, fee-based, or commission-based? And finally, number 4, verify everything. Use the free tools on the FINRA and SEC websites to check their credentials and look for any red flags. Seriously, it takes like 5 minutes and it could save you a world of trouble.
See, finding an advisor you can trust really doesn't have to be this big, scary mystery. By understanding the conflicts, by decoding the titles, and by asking that one simple question about payment, you are in complete control. So now you've got the playbook, you know the rules. The only question left is, are you ready to use this knowledge to build the financial future you deserve? All right, let's talk about something that's absolutely crucial for smart investing, but honestly, it often gets ignored: portfolio rebalancing. Think of it like a regular tune-up for your investments. Now, I know it sounds a little technical, but trust me, by the end of this, you'll see it's a really simple, powerful way to keep your entire financial plan right on track. So let's dive in. You know, I love this quote from Jean Brown. It's just a perfect kind of humble place to start. It's a great reminder that even the most brilliant investment strategy out there can't just be set and forget. The markets are always moving, things are always changing, and our plans, well, they need a little maintenance to stay sharp. So here's a kind of wild question for you. What if your biggest winners, the investments you're most proud of, were actually making your entire portfolio more dangerous? It's a strange idea, right? But as you're about to see, when one part of your portfolio soars, it can quietly throw your whole strategy way out of balance, exposing you to risks you never, ever intended to take. So here's our game plan for today. First, we're going to uncover this problem I'm talking about, this portfolio drift. Then we'll define exactly what rebalancing is. After that, we get into the really practical stuff, how to build your game plan, how to do it smartly, and we'll wrap up with some final pro tips to take with you. Okay, first up, this idea of the unseen drift. This is all about how the day-to-day movements of the market can slowly, almost silently, push your investment plan way off course.
I mean, for a perfect and kind of scary example of this, you just have to look back at the dot-com bubble. You had investors who started with maybe a small piece of their portfolio in tech stocks, but as the bubble inflated, those positions swelled and became this huge part of their net worth. They were just letting their winners run, right? But when that bubble finally burst, the people who hadn't rebalanced, who hadn't taken some of those profits off the table, they faced devastating losses. It's such a powerful lesson in why we need to manage our risk, not let the market do it for us.
And look at how subtle this drift can be when things are going well. Let's say you start with a target of 60% in stocks. After a pretty good year, that might just creep up to 61%.
It feels insignificant, right? It barely even registers. But this is exactly how the imbalance begins. But now let's flip that around. Look what happens in a downturn. A 20% drop in stocks can shrink that part of your portfolio all the way down to 53%. All of a sudden, without you doing a single thing, your portfolio has become way too conservative, and you're not in the right position to really benefit when the market eventually bounces back. And here's what that drift looks like visually. You started with this nice, clean 60-40 plan, but the market has shoved you into a much more cautious 53-47 mix. Your actual portfolio, it just doesn't match your strategy anymore. So how do we fix this? How do we fight back against that drift? Well, the answer is rebalancing. It's how you grab the steering wheel back from the market and put you back in control. And the definition itself is beautifully simple. Rebalancing is really just the act of hitting the reset button on your portfolio. I like to think of it like a recipe. You're just making sure you have the right proportions of all your ingredients, trimming back what's gotten too big and adding a little more of what's gotten too small. So why bother? Well, rebalancing does two incredibly important things for you. First, and this is the big one, it controls your risk. It makes sure you're always invested at that comfort level you chose from the very beginning. But second, it enforces this powerful discipline. It actually forces you to do what every investor dreams of doing. Systematically sell what's done well, that's selling high, and buy what's underperformed, that's buying low. And hey, this isn't just some theory. Studies that look at this stuff, using metrics like the Sharpe ratio, which basically just measures how much return you're getting for the risk you're taking, they all show the same thing. Portfolios that aren't rebalanced end up taking on more and more risk, but without getting paid for it in extra returns. It's like you're taking on all the stress with none of the benefit. Okay, so hopefully we're all on board that it's a good idea. But the next big question is, when do you actually do it? That's what this game plan is all about. You've basically got two main options here, two different triggers. You can rebalance based on time, say every year or every 18 months. That's super simple, easy to remember. Or you can use percentage bands. For example, if your 60% stock target drifts up to 65% or down to 55%, that's your trigger to rebalance. This way is more responsive to big market swings. But yeah, you have to monitor it a bit more. There's no single right answer. The best strategy is just the one you'll actually stick to. So, let's say your trigger goes off, it's time to rebalance. How do you actually do it? Let's walk through 4 really smart, practical ways to get your portfolio right back in line. Now, a lot of people think rebalancing always means you have to sell things, but that's not true. The easiest way, especially if you're still saving, is to just use new money. If you're adding to your portfolio, just put that cash toward the part that's lagging behind. Simple. You can also redirect your dividends to buy what's needed. If you're retired and taking money out, just withdraw from your winners. And then, of course, there's the classic approach, selling a bit of what's done well to buy more of what hasn't. All right, to wrap things up, let's go over a few final pro tips that can make your rebalancing strategy even better, especially when it comes to being smart about taxes and just making your life easier. Okay, here's a quick rundown. First off, always try to do your rebalancing inside tax-deferred accounts, like your 401k or IRA. No tax consequences in there. If you do have to sell winners in a regular brokerage account, think about waiting until January. That can push the tax bill an entire year down the road. For a time-based plan, pick a date you'll actually remember, like your birthday. And finally, don't forget you can also sell things that have lost money to get a tax break. That's called tax loss harvesting. Now, look, if all of this manual work sounds like a total chore, there is a set it and forget it option. It's called a fund of funds, and you've probably heard of them, things like target date funds. These funds do all of the rebalancing for you, automatically, behind the scenes. It's a fantastic solution if you just want a hands-off approach. So, what's the ultimate takeaway from all this? It's really this. The absolute best rebalancing plan is the one you'll actually follow. It doesn't matter as much if it's time-based or percentage-based. What matters is that you have a system and you stick with it, through the good times and the bad. So, there you have it. The why, the when, and the how of rebalancing. You know it's all about controlling your risk and keeping yourself disciplined. The only question left is, when are you going to start? There's really no better time than right now to take a look at your portfolio and put your plan into action. Hey everyone, and welcome. Have you ever felt like you're just drowning in financial news, stock tips, and market predictions? Well, if you have, then you're in exactly the right place. We're going to cut through all that clutter and focus on what really, truly works for long-term success. You know, this quote just sets the stage perfectly. Think about it. It's a pretty sharp warning about anyone who claims to predict the future of investing. A fake fortune teller is, mostly harmless fun. But someone who could actually predict the future? That would be dangerously powerful. It's a really important idea to keep in your back pocket as we dive into all this. The thing is, we're living in a completely new world. It's the age of what some people call the investor class. Investing isn't just for the super rich in some high-rise anymore. It's become a totally mainstream thing for millions and millions of us. And the scale of this change is just staggering. Look at this chart. Back in 1980, a tiny 6% of households owned mutual funds. But flash forward to today, that number has rocketed to over half of all households. This created a massive, and I mean massive, new market for financial products and, of course, financial advice. And you know what came with that new market? An absolute avalanche of information. We're talking 24-hour TV channels, endless newsletters, websites, all pumping out a constant stream of stuff. We're going to call this what it is, noise. Just a constant, relentless storm of it. So, this brings us to the most important question you can ask. Is all this noise actually helping you make better decisions? Or is it just a machine designed to make somebody else rich, probably at your expense? Okay, so let's start by digging into where this noise actually comes from, because it's super important to realize that the goals of the financial media are, more often than not, in direct conflict with your goals as a long-term investor. This slide just lays it out so clearly. The media's business model is simple, right? Grab and hold your attention so they can sell ads. They need eyeballs and clicks to survive. But your goal, it's to make smart, calm, long-term decisions. The very excitement and drama that they need to sell ads is pretty much the exact opposite of what you need to be a successful investor. All right, now let's build on that, because it's not just the media. Wall Street itself has this gigantic marketing machine, and the whole thing is built on one single, incredibly powerful promise. And there it is. That's the pitch. It doesn't matter if it's a brokerage firm, a fund manager, or some guru on TV. The message underneath it all is always the same. We've got the secret. We know how to do better than everyone else. We can beat the market. 80%. Just look at that number. Let it sink in for a second. 80%. What on earth do you think that represents in the world of investing? Well, it represents the cold, hard reality check behind that big promise. 80% is roughly the chance that the professional money managers, the experts, will actually fail to beat the overall market over the long run, especially once you account for the fees they charge. The odds are just overwhelmingly against their big promise. As investment manager Rick Ferry just nails it, Wall Street wants you to believe they're there to make money for you, but their true purpose is to make money from you. So the whole business model depends on you believing in their promise, even when the data says you probably shouldn't. Okay, so if the noise is designed to trip us up, what's the antidote? Well, it turns out the truth is shockingly simple and, yeah, maybe a little bit boring. And trust me, that's a really good thing. This is it. This is the simple playbook that, based on decades of evidence, will let you outperform about 80% of the pros. First, you create a simple diversified plan. Spread your money around. Second, you invest regularly in low-cost index funds, which basically just own a tiny piece of the whole market. And third, and this is the hardest part, you rebalance when you need to, and then you just stay the course. No drama, no genius predictions necessary. I know, this goes against every single instinct the noise tries to trigger in us. But listen to Warren Buffett, arguably one of the best investors of all time. He said, inactivity strikes us as intelligent behavior. The media and Wall Street want you to do something constantly, but very often the absolute smartest move is to do nothing at all. The source material for this explainer uses a pretty potent term for all this noise. It's called investment pornography. And what is it? It's content that's designed to get you excited, to get your heart pumping with the idea of getting rich quick and beating the market. But just like the term suggests, it's ultimately unfulfilling, because those promises almost never deliver. So let's get really specific. What are the actual stories, the big lies that Wall Street and the media use to keep us watching and, more importantly, keep us trading?
Here are two of the biggest ones. I bet you've heard these a million times. First, it's a stock picker's market. This implies that right now is a special time when the experts can finally work their magic. And second, the trend is your friend, which just encourages you to chase whatever's hot.
But let's look at the only trend that has ever really mattered. This slide is so powerful. Look, over any given one-year period, you've got about a 1 in 3 chance of losing money. But watch what happens as you stretch out the timeline. At 5 years, your odds of losing drop to 13%. At 10 years, just 2%. And historically, if you stayed in for 15 years or more, your chance of losing money dropped all the way to 0. Now that's a trend you want to be friends with. Everything else is just noise.
And as for that idea that it's a stock picker's market, well, Nobel Prize winner Eugene Fama had this to say about that. I'd compare stock pickers to astrologers, but I don't want to badmouth astrologers. That pretty much tells you everything you need to know about what the real experts think.
Okay, so how do we actually put all this into practice? Let's finish up with a practical toolkit. Think of it as a set of mental rules you can use to spot the noise and just tune it out so you can protect your own financial future. I want to leave you with a little thought experiment, and I want you to be really honest with yourself. If you woke up tomorrow and you had the 100% foolproof ability to predict the stock market, what would you actually do with that power? This slide lays out the only logical answer. What do all the self-proclaimed forecasters do? They sell you newsletters, they go on TV, they host seminars. But what would a real prophet do? Someone who actually knew. They'd shut their mouth, they'd borrow every cent they could get their hands on, and they'd quietly become the richest person in the world. The fact that they're selling their predictions instead of just using them, well, that tells you everything. And really, that's what this all comes down to. There's a huge difference between good information and information that just sounds good. Information that sounds good is exciting, it's confident, it's full of big promises. But information that is good is based on evidence, on data, and on logic. Your entire financial future really depends on your ability to tell the difference. So the question I'll leave you is, do you know which one you're listening to?
All right, let's talk about the biggest battle in finance. And you know what? It's not happening on Wall Street. It's happening right between your ears. It's this constant tug of war between logic and emotion, a fight that can literally make or break your entire financial future. So let's dive right in.
You know, Mark Twain really hit the nail on the head with this one. You aim for the palace and get drowned in the sewer. It's so true, isn't it? We all have this dream of building a financial palace, right? But it just takes one bad emotional decision to send everything you've built straight down the drain. And look, this isn't just some clever line. It's the harsh reality for so many investors who let their feelings get behind the wheel.
And this leads us to something really fascinating, kinda a central conflict in all of this. We call it the investor's paradox. And it's this weird, counterintuitive idea that the very things that make you successful in life can be absolutely toxic when you're dealing with your money.
I mean, just look at this comparison. It lays it out so clearly. In life, right? Emotions are great. Optimism drives success, it motivates us, builds relationships, makes us happy. But in investing, whoa, it's the complete opposite. That same optimism, it morphs into dangerous overconfidence. That motivation, it turns into chasing hot, risky stocks. And that emotional drive, well, it can lead you straight to a financial wreck. It's a total flip.
So, what's the deal here? Why is our brain, this amazing machine that's so good at navigating daily life, just so bad when it comes to Wall Street? Well, to figure that out, we've got to dig into the science. We need to diagnose what's actually going on in our heads.
Okay, so there's this whole field of study called behavioral economics. And these two guys, Daniel Kahneman and Amos Tversky, they were the pioneers. They basically flipped traditional economics on its head. See, the old models assumed we're all these perfectly rational beings, always making the best choice for ourselves. But Kahneman and Tversky proved that's just not true. We're not robots. We take mental shortcuts, we get swayed by our feelings, and a lot of the time we make totally irrational decisions.
And when we're talking about investing, there are two emotions that are just massive, primal drivers. The two big villains of the story, really. Greed and fear. Greed, oh man, that's that intoxicating feeling, that drive for more. It's the little voice that tells you to chase that hot stock everyone's buzzing about, which of course means you're buying high. And on the flip side, you've got fear. That sheer terror of losing money. It's what causes that gut-wrenching panic when the market dips, and it screams at you to sell low and just lock in your losses. A perfect recipe for disaster.
You know, this really gets to the heart of it all.
There's this quote from an old comic strip, Pogo, that just says it all. We have met the enemy, and he is us. And that's it right there. The biggest threat to your portfolio, it isn't some sudden market crash or a bad economy. Nope. It's that person looking back at you in the mirror. It's our own impulse to do the exact wrong thing at the exact wrong time.
Okay, so I know what you might be thinking right now. Sure, that makes sense for the average person, for amateurs, but not me, and surely not really, really smart people, right? Well, you might want to think again. We're about to look at 3 little cautionary tales that prove that being a genius is absolutely no defense against your own brain.
Just think about it for a second. Come on, be honest. Have you ever looked back at an investment you made and just thought, what on earth was I thinking? Maybe you bought that one stock right at its absolute peak, or sold everything just seconds before it shot back up. Yeah, we've all been there. And you know what the culprit usually is? One simple, powerful thing: overconfidence.
So our first story is about a group called the Beardstown Ladies. These were a bunch of grandmothers from Illinois who started an investment club, and they got super famous back in the 90s. They even wrote books saying they were getting these incredible 23.4% returns every year. People went crazy for it, but then a journalist decided to actually check their math. And guess what? Their real return was only 9.1%. They were actually doing worse than the market. And it wasn't even fraud. They just didn't know how to calculate returns correctly, and their overconfidence made them believe their own hype.
Okay, fine. So they were amateurs. What about certified geniuses? Let's talk about the Mensa Investment Club. We're talking about a group for people in the top 2% of IQ on the planet. You'd think these guys would absolutely crush the market, right? Well, over 15 years, their average annual return was, wait for it, a measly 2.5%. Yeah, you heard that right.
And this chart, wow. This really puts it all into perspective. Just look at the difference here. The Mensa Club, the certified geniuses, are pulling in 2.5%. Meanwhile, the S&P 500, something you could have just bought and forgotten about, was returning over 15% a year. It's staggering. It just goes to show you that a high IQ doesn't just not help, it seems like it can actually hurt you. But if you want the ultimate cautionary tale, the grand finale, this one involves not just geniuses, but actual Nobel Prize-winning economists. These guys started a hedge fund called Long-Term Capital Management. They were so confident in their super complex models that they believed they had basically solved investing and eliminated risk. Well, instead of eliminating risk, their fund imploded so spectacularly in 1998 that it almost took the entire global economy down with it. The lesson here is crystal clear. If literal Nobel Prize winners can get it this catastrophically wrong, then believe me, anybody can. So what are the actual mental glitches that cause these massive blowups? Well, it's usually one of these common traps. You've got overconfidence, which we've seen plenty of. Then there's loss aversion. That's the psychological quirk where a loss hurts about twice as much as a win feels good. Of course, there's following the herd. Buying just because everyone else is buying. There's anchoring, where you get stuck on an old price or idea. And finally, recency bias, which is just the dumb assumption that whatever has been happening lately is going to happen forever. Okay, so that's a pretty grim diagnosis, right? Our brains are basically wired to mess this stuff up. But here's the good news. We can fight back. We don't have to be victims of our own wiring. All it takes is a solid, unemotional, call it a battle plan. First things first, we need a major mindset shift. Investing is not supposed to be an amusement park. If you want excitement, go to Vegas, go skydiving. Investing should be, well, it should be kind of boring. It's a process, not a thrill ride. If you're chasing that adrenaline rush in your portfolio, I can almost guarantee you're going to lose money. Find your thrills somewhere else. So what does this boring, effective process actually look like? It's really just 4 simple steps. Step 1, write down your goals. Know exactly what you're aiming for and when. Step 2, create a simple plan. Figure out your asset allocation and, this is the crucial part, stick to it no matter what. Step 3, automate your investing. Set it up so money comes out of every paycheck without you even thinking about it. No temptation. And finally, step 4, tune out all the noise. That means turning off the screaming heads on TV, ignoring the hot tips from your friends, and just letting your plan do its thing. Okay, but look, I get it. Some of us just have that itch to speculate. So if that's you, here's a little trick. The casino account. Take a tiny piece of your portfolio, and I mean tiny, like 5% max, and put it in a separate account. Go nuts. Trade with it. Speculate. Do whatever you want. But there's one unbreakable rule. If you lose that money, it is gone, forever. No refills. This way, you can scratch that itch without setting your whole financial future on fire.
All right, so we've covered a lot of ground. We've talked about the paradox, the psychology, we've seen some pretty epic failures, and we've laid out a battle plan. And all of that brings us to the final, and honestly, the single most important takeaway from all of this.
So after all of this, after the stories about the grandmothers and the geniuses and the Nobel winners, after talking about greed and fear, let me ask you, who is your biggest financial enemy? Who is the single biggest threat to you reaching your goals?
It's the person looking back at you in the mirror. That's it. The real secret to mastering your investments has nothing to do with picking the perfect stock or timing the market. It has everything to do with mastering your own emotions. It's about having the discipline to get out of your own way. If you can master yourself, you've already won the game.
So, how do you make absolutely sure that your money outlives you? That's really the big question for anyone dreaming of retirement, right? Today, we're going to dig into the Bogleheads Guide to Investing to build a solid plan to answer it. Let's get right into it.
I love this quote from comedian Henny Youngman. It's funny because it's just so true. It perfectly nails the core anxiety of retirement. You've spent your entire life building up this nest egg, but the one thing you can't possibly know for sure is how long it actually needs to last. It's all about the timing.
And that leads us right here to the big one. This is the question that keeps people staring at the ceiling at 3 a.m., right? Picturing those worst-case scenarios of, eating cat food and crackers in their golden years. So, that's what we're here to do. Build a clear, sensible framework to finally answer it. Here's our game plan. First, we'll look at why this question is trickier than it seems. Then, we'll explore the 2 major mistakes to avoid. After that, we'll talk about building a flexible strategy. And finally, we'll get to a clear spending rule that can guide you.
So why can't we just plug some numbers into a spreadsheet and get the perfect answer? Well, it's because we're trying to predict the future. And, as we all know, the future is packed with unknowns.
I mean, just look at this list. To get a perfect answer to our question, you need to know all of this ahead of time. And since none of us have a crystal ball, a single perfect number is impossible. What we need instead is a strategy that's flexible and resilient.
Okay, so this brings us to the core challenge every single retiree faces. When it comes to spending your nest egg, think of it like a road. There are 2 big ditches, one on either side, and our goal is to drive right down the middle.
On one side, you've got the obvious danger, overspending. This is the one mistake you absolutely cannot afford to make because running out of money when you're older is a true catastrophe. But there's a more subtle danger on the other side of the road, underspending. This is when fear takes over, causing you to hoard every penny and miss out on the life you worked so hard to build.
And to see just how serious underspending can be, let's look at the true story of a guy named Jacob Leader. He drove an old car, lived in a pretty modest home, and would spend his days watching stock reports at his girlfriend's house because he didn't even have his own cable. Well, when Mr. Leader passed away, his secret finally came out. He left behind an estate worth, get this, a staggering $36 million. It was a total shock to everyone, especially his girlfriend of 24 years, who got almost nothing. He had lived this life of extreme frugality when he could have had literally anything he wanted.
And his story really drives home this powerful lesson, doesn't it? The goal isn't to die with the most money. It's to use your money to live the richest life you possibly can. It's all about finding that balance. So how do we build a strategy that helps us do that? All right, so how do we stay on that road and avoid both overspending and underspending? The answer isn't some rigid, complicated rule. It's actually a single, powerful idea. If the Boy Scouts motto is be prepared, then the retiree's motto absolutely has to be flexible. The reality is life is unpredictable. The market zigs and zags. Your needs will change. Any successful retirement plan has to be able to adapt to what's actually happening. So here are 2 of the most effective ways to build that flexibility right into your plan. First, keeping your fixed expenses low gives you so much breathing room. When the market has a bad year, it's way easier to cut back on travel or dinners out than it is to pay a giant mortgage. And second, having a way to earn some income, even if it's just part-time, is a powerful safety valve. Every single dollar you earn is a dollar you don't have to pull from your portfolio.
Okay, so beyond those two foundational ideas, there are other strategic levers you can pull to make your financial plan even more secure. Think of these as more tools for your toolkit.
Let's run through these real quick. First, delaying retirement is incredibly powerful. It's one more year you're saving and one less year you're spending. Simple, but huge. Second, optimizing your Social Security by waiting can seriously boost your guaranteed inflation-adjusted income for life. And finally, you could look at an annuity. It's basically an insurance product that gives you a guaranteed income stream. But, and this is a big but, it's crucial to understand the downsides, like inflation risk and sometimes low payouts, especially if you're younger.
All right, we've built the foundation of flexibility. Now it's time to tackle that big question from the beginning and find a rule of thumb that can free us from that fear that paralyzed Jacob Leader. How much can you actually withdraw?
First things first, let's just bust a common and really dangerous myth. Some people figure, hey, the stock market has historically returned about 10% a year, so I can just withdraw 10%. This quote exposes the flaw in that logic perfectly. Market returns aren't smooth, they're volatile, and withdrawing 10% during a bear market can permanently cripple your portfolio. And you have to remember, your money probably needs to last a lot longer than you think. For a 65-year-old couple, there's almost a 50-50 chance that one of them will live to age 90 or even longer. This is exactly why a conservative withdrawal rate is absolutely essential for your long-term success.
So what is a safe and sustainable withdrawal rate? Well, after analyzing decades and decades of historical data, researchers have landed on a number that has really stood the test of time: 4%.
So how does this 4% rule actually work in practice? Well, there are two main ways to go about it. The first is the inflation-adjusted method. You take 4% of your portfolio's value when you first retire, and then each year after that, you just adjust that dollar amount for inflation. It gives you a steady paycheck. The second way is the fixed percentage method. Here, you take a fixed percentage, say 5%, of whatever your portfolio's current value is each year. This means your income will go up and down with the market. You get a raise in good years, but you have to take a pay cut in bad years. Both of them are really solid, prudent strategies.
And you know, that really brings us to the most important point of all. A plan, a strategy, a number like 4%, these are just tools. The real purpose is to give you the confidence to stop worrying about the money and to start living the life you've worked so hard for. Because after all, the goal isn't to die rich, it's to live a rich life.
Hey everyone, and welcome. Today, we're going to tackle a topic that most of us have, but maybe don't fully get: insurance. We're going to figure out if your policies are actually a financial shield or just a drain on your wallet.
And that's really the bottom line, isn't it? You know, no matter how careful we are, life is going to throw some curveballs. It's just a given. So the real question is, how are you set up for the financial hit when it happens?
I want you to really think about this for a second. Think about the policies you're paying for right now. Are they set up to protect you from a genuine, life-altering disaster? Or are they just a bunch of separate bills that don't really cover the things that could truly sink you? That's what we're going to dig into.
You see, for most of us, we don't really have an insurance strategy. We just kind of collect policies along the way, right? Car insurance when we get a car, homeowners when we buy a house. Maybe we even get that warranty on a new laptop. But this piecemeal approach, well, it leaves some pretty scary holes in our financial armor. So let's break down the 3 biggest mistakes that pretty much all of us make. Okay, this one is huge. We get so focused on insuring against the small stuff, things that would be annoying but that we could probably cover ourselves, while at the same time we leave ourselves wide open to the events that could literally wipe out everything we've worked for.
And this right here just says it all. I mean, think about it. A broken dishwasher is an inconvenience, a hassle. But a multi-million-dollar lawsuit because of a car accident? That is a financial apocalypse. And yet, we're way more likely to insure the dishwasher. Our priorities are totally backwards.
We do this all the time. We think, the chances of that happening are basically zero, so I don't need to worry about it. But that is such a dangerous way to look at risk. The question you should be asking isn't, how likely is this to happen? It's, how completely screwed would I be if it did happen?
And this is the perfect way to think about it. Yeah, a flood in the middle of a desert is pretty unlikely. But if it happened and you lost your home and everything in it, could you financially recover? If the answer is no, then you absolutely need the insurance. And here's the kicker. Those super low odds are exactly what makes the policy so cheap.
Have you ever seen those insurance policies they try to sell you at the airport for a plane crash, or policies that only cover one specific disease? These things are basically designed to play on our fears. It's so much smarter and way more efficient to just buy one broad, comprehensive life insurance policy that's going to cover you no matter what the cause is. Okay, so we've talked about all the ways we get it wrong, but here's the good news. The fix is actually really simple. It all comes down to 3 basic rules that will help you build a financial fortress. This slide right here, this is the whole game plan. Rule number 1, only insure against the big stuff, the true catastrophes. Use insurance for what it was made for, to stop financial ruin, not to fix a cracked phone screen. Rule 2, jack up your deductibles as high as you can comfortably afford to pay out of pocket. Seriously, this one move can slash your premiums because you're telling the insurance company you'll handle the small bumps yourself. And Rule 3, this is crucial. Your policy is worthless if the company can't pay. Make sure you're with a rock-solid company that can actually write a massive check if the worst happens.
All right, so that's the theory. But how does this actually play out with the policies you need? Let's walk through the big ones and see how to apply these rules.
Let's be crystal clear about life insurance. Its only job is to replace your income for the people who depend on it if you're not around. That's it. If nobody relies on you financially, you probably don't even need it. The absolute biggest mistake people make here is trying to turn it into an investment.
So here's the choice, and it's pretty stark. You've got term insurance, which is pure, simple, and cheap protection. It does one thing, and it does it really well. Then you've got these complicated cash value policies that try to be both insurance and an investment, but they are loaded with insane fees and huge sales commissions that just eat up your money. For almost everyone, the smart move is simple. Buy cheap term insurance and then invest the money you saved on your own.
Just let that sink in for a second. It's not your house. It's not your retirement account. Your single biggest asset is your ability to get up and earn a paycheck for the next few decades. And that brings us to what might be the most important and most ignored insurance there is, disability insurance.
Whoa, look at this gap. It's wild. 70% of us have life insurance, but only 40% of us insure our ability to work. And yet, the stats are clear. You are way more likely to become disabled during your career than you are to die young. This is a massive blind spot in most people's financial plan. Now for your stuff, your house, your car, be smart here. Your home needs to be insured for what it would cost to rebuild it. That's replacement cost, not what you paid for it. For your old car that isn't worth much, think about dropping collision coverage. You might be paying more in premiums than the car is even worth. But, and this is the big one, the absolute most critical piece of this puzzle is an umbrella liability policy. It's cheap, and it kicks in if you get hit with a massive lawsuit that goes beyond your normal coverage. It is the ultimate asset protector. Okay, last but not least, let's talk about protecting the nest egg you spent your entire life building, and that means facing the massive potential cost of long-term care.
Just look at that number. 600 out of 1,000 people will need some form of long-term care. Now compare that to the odds of your house burning down, which is something like 5 in 1,000. We all have homeowners insurance, right? But we ignore a risk that is literally over 100 times more likely to happen.
And honestly, 50 grand is a low estimate. In a lot of places, it's easily over $100,000 a year. A few years of that can completely incinerate a lifetime of savings, money that was supposed to be for your retirement or for your kids. This is the definition of a financial catastrophe.
Now, this kind of insurance isn't for absolutely everyone. If you're super wealthy, you can probably just pay for care out of pocket. If you have very few assets, you'll likely qualify for government help. This is for everyone in the middle, the people who have saved up a solid nest egg and want to make sure a health crisis doesn't wipe it all out.
Look, this can all feel like a lot, so please don't try to figure it all out by yourself. A good independent agent is worth their weight in gold because they work for you, not for one specific company. Look for these kinds of credentials on the screen. They're like a shorthand for serious expertise. And whatever you do before you sign on the dotted line, make sure the company has a top-tier financial rating.
And that's really what smart insurance is all about. It's not about being negative, it's about being a realist. It's about making sure that if and when that unexpected train comes roaring down the track, your financial life isn't tied to it. Thanks so much for watching.
All right, let's talk about something that, let's be honest, most of us would rather not think about: estate planning. And right away, let's be clear, this is not just for the super wealthy. This is for everyone. It's all about making sure that everything you've worked for your entire life gets passed on exactly the way you want. So let's dive into how you can take control.
I love this quote from Gloria Steinem. It just hits the nail on the head, right? It's not just about money. It's about a mindset. Are we thinking about tonight, or are we thinking about building a real legacy? A legacy that could be anything, securing your family's future, supporting a cause you believe in, you name it.
And that really is the question for you, isn't it? What are you planning for? Is it just for Saturday night, or is it for the generations that follow? Over the next few minutes, we're going to give you the tools you need to answer that question with total confidence. So let's get into why this plan of yours is so incredibly important. At the end of the day, it's about peace of mind. After a lifetime of working hard, you want to know, for sure, that your assets are going to the right people in the right way without a ton of drama or delay. You've heard this a million times, right? Death and taxes. And yeah, it sounds a little grim. But facing these two things head-on isn't morbid. Actually, it's one of the most thoughtful and responsible things you can possibly do for the people you love. Okay, so you might be thinking, what happens if I just don't do any of this? Well, here's the thing. You don't get to just opt out. If you don't make a plan, the state will make one for you. And trust me, you probably won't like it. The legal term for dying without a will is intestate. When that happens, the government's rulebook takes over. And this is the part that should really get your attention, especially if you have kids. It means a judge who doesn't know you or your family gets to decide who raises your children. And as for your assets, the state's formula might send them to people you'd never have chosen. And this whole state-run process, it has a name: probate. Think of it as the default legal pathway. It's the court system for dotting the I's and crossing the T's. Even if you have a basic will, your estate will likely still end up in probate court. And when you put them side by side, the difference is just stark. With your plan, your wishes are respected, it all happens privately, and it's generally pretty efficient. But with the state's plan, probate, you get the exact opposite. A court decides, it's all public for anyone to see, and it can be incredibly expensive and drag on for months or even years. All right, we've seen what can go wrong. The good news? It's all preventable. So let's talk solutions. Think of these next few things as your essential legal toolkit. These are the documents that put you back in the driver's seat. First up is the big one, the will. We all know it's where you say who gets your stuff, but here's the single most important thing a will does, and I can't stress this enough. It is the only legal document where you can name a guardian for your minor children. For parents, that alone makes it non-negotiable. Next up is a living trust. Now this one's a little more involved, but stick with me. You essentially create a private entity, the trust, and you move your assets into it. The huge benefits? 2 massive wins here. It lets your estate completely sidestep probate, and it keeps everything 100% private. So, will versus living trust. Let's break down the trade-offs. A will is definitely cheaper and simpler to set up, but it almost always lands you in probate, which is public. A living trust costs more upfront, no doubt, but what you're buying is privacy and an immediate, seamless transition of your assets. The right call just depends on what's most important to you.
You know, a lot of people think estate planning is just about what happens after you're gone, but that's not true at all. Powers of attorney are for while you're still alive. They let you appoint someone you trust to make financial and healthcare decisions for you if you ever reach a point where you can't make them for yourself. And along those same lines is the Advanced Healthcare Directive, sometimes called a living will. This one isn't about your stuff. It's about you. It's where you state your exact wishes for medical care if you can't communicate. You're taking an impossible, gut-wrenching decision off of your loved one's shoulders. And if you need proof of why this is so critical, just look at the Terry Schiavo case. It was a heartbreaking 7-year public legal war fought by her family, all because her wishes were never written down. All of that pain, all of that conflict, it could have been prevented with a single document.
Okay, so we've got the foundational documents locked down, the must-haves. Now let's get a little more strategic. Let's talk about smart, tax-efficient ways to pass on what you've built. One of the simplest tools in the box is the annual gift exclusion. Now, the exact number changes over time with inflation, but the principle stays the same. Each year, you can give a certain amount of money to as many different people as you want, completely tax-free. It's a fantastic way to slowly and steadily reduce the size of your taxable estate. Okay, now for what is seriously one of the biggest tax breaks in the entire system. It's called the stepped-up basis, and it can save your family a ton of money. Let's walk through this. Imagine you buy stock for $10,000. Over the years, it grows to be worth $100,000. Now, if you sell it, you're paying capital gains tax on that $90,000 profit. But if you pass it on to your heir instead, their cost basis steps up to the current value.
that $90,000 taxable gain, poof, it's completely erased. That is a huge deal. Finally, let's move beyond the legal and the financial. Some of the most important parts of a plan aren't about money at all. They're about providing clarity and comfort to your family when they need it most. A letter of instruction is not a legally binding document, but it is incredibly valuable. Think of it as the user manual for your life that you leave behind. It's where you can spell out your funeral wishes, tell them where all the important papers are, and leave any final messages. It's a roadmap, and it's a final act of care. So we end right where we started, with a question. You've spent your whole life building something meaningful. The only question left is, how will you make sure it's passed on with the care and intention it deserves? That's what this is all about. The choice and the power is all yours.
All right, so we've walked through all the theories, all the strategies, but now we get to the most important part. The part that's all about one simple, powerful belief, that you can actually do this. This is where we stop talking and start doing.
I love this quote from Carl Bard because it hits the nail on the head, right? It doesn't matter what your investing story has been up to this point. Maybe it's full of mistakes, maybe it's a blank page. The key thing to remember is that your financial future, that brand new ending, well, it kicks off right now. And that's really the beauty of this whole Bogleheads approach, you know? It meets you exactly where you are. So are you a brand new investor, kind of nervous, hoping to get it right from the start? Or maybe you've been at this for a while, but you still feel a bit lost in the weeds. Heck, you might even be a seasoned pro who's been burned by complexity and is just ready for a simpler way. It doesn't matter which one you are. This is for you. So, no matter where you're starting from, it's time to grab the wheel. Think of yourself as the captain of your own financial ship. The past? That's just the wake behind you. All the currents, the storms, they're done. What matters is that you're at the helm right now, ready to chart a new course.
Okay, so forget about all that complex market timing and chasing the next big thing. You want to know the single biggest enemy of your financial success? It's procrastination, just putting it off. The most powerful move you can make isn't some secret stock pick. Nope, it's the simple decision right here, right now, to just get started.
So how do we do it? How do we actually make this happen? Well, it all boils down to a clear set of guiding principles. Think of them as your toolkit for success. These are the core ideas you're going to come back to again and again. And the journey doesn't actually start with picking stocks or bonds. Not at all. It starts right here with you, with your personal habits and your mindset. This is the absolute foundation. Get this right, and everything else gets a whole lot easier. Okay, so let's break down these core habits. First up, live below your means. Simple, right? That's what frees up cash to invest in the first place. Then start early and invest regularly to let that magic of compounding do its thing. But just as critical, maybe even more so, is mastering your own emotions. You've got to learn to tune out all that noise, the fear, the greed, the crazy 24/7 news cycle that is designed to make you panic.
All right, once you've got that foundation of good habits in place, the next layer is your actual strategy. And listen, the goal here is not complexity. It's about creating a simple, sensible, and repeatable plan that's going to get you from point A to point B.
And these are the pillars of that strategy. It all begins with a simple asset allocation plan, one that fits your goals, not someone else's. And for most of us, the core of that plan is going to be low-cost index funds. From there, the rules are easy. Know what you actually own and diversify, so that when some of your investments are zigging, others are zagging, it just smooths out the ride.
Now, this next principle, this might be the most empowering one of them all. Seriously, the financial world can feel so chaotic and uncertain, right? Well, success comes from forgetting all that and focusing like a laser on the few powerful things that are completely within your control.
Just take a look at this. On the left, you've got everything you can't control. The market's daily mood swings, scary news headlines, inflation, forget about it. Now look at the right. This is your domain. You can control your investment costs, your personal plan, your rebalancing strategy, and your taxes. And let me tell you, controlling just that one thing, costs, is like a superpower. Get this, a tiny 1% difference in fees can eat up almost a third of your total returns over 30 years. It's staggering. The whole secret here isn't trying to predict the stuff on the left. It's about absolutely mastering the stuff on the right.
Okay, so having the right principles is great, but sticking to them when things get scary, that's a whole different ballgame. And here's the best part. You don't have to do it alone. You are not on an island here. There's an entire community built around these exact ideas, and they're ready to help.
So if you ever have a question, or you just need a quick gut check on your plan, or you want to learn from people who've been there, Bogleheads.org is the place to be. It's the online home for this huge community of investors, all there to help each other out.
And don't think this is some small niche club. No way. This forum is packed with incredibly smart people from every walk of life. We're talking lawyers, doctors, educators, even certified financial pros. But you know who's the most important group there? It's the thousands and thousands of regular investors just like you who are on the exact same path.
And this is not some echo chamber where everybody agrees on everything. Far from it. It's a global community with some really spirited, healthy debates about, well, everything, from which funds are best to different retirement strategies. You can find local chapters to meet up with people in person or just soak up all that shared knowledge online. It's a living, breathing resource.
So when you pull it all together, what's the ultimate mission? What's the one takeaway? It really boils down to one of the most famous phrases in investing. A simple mantra that perfectly sums up this entire philosophy. Stay the course. It honestly is this simple. Step 1, create a personal financial plan that actually works for you. Step 2, put that plan into action using simple, low-cost tools like index funds. And step 3, and yeah, this is the hardest part, you have to resist all the distractions and just stick with your plan, through good times and bad. That's it. That is the whole secret. You know, the financial industry, they love complexity. It's how they make themselves seem smart and essential. But the Bogleheads philosophy just cuts right through that. It shows you the truth. Your greatest advantage isn't some complex strategy. It's having a simple, understandable plan that you can actually stick with for the long haul.
And that's it. We've reached the end of our journey here. You have the tools. You have the guiding principles. You have a whole community ready to back you up. The path forward is crystal clear. So the only question left is the one you see right here. Your brand new ending starts now. What's your first step?